actually find
GDP story. We'll work our way towards the payrolls number on Friday. And Brent crude, worth keeping an eye on now with a 74 handle. Tom, what do you see on futures?
Looks to be a rough session for the FTSE 100. Futures pointing lower by 0.6%. DAX futures pointing off by 60 points. And over in France, the CAC current pointing lower by around 17 points, down 0.2%.
Okay, let's look at how these European equity markets open up. We are expecting a bit of weakness then, as Tom was just going through then in the futures picture. US futures are pretty flat, though, pretty undecided as we head towards an important data point tomorrow and important central bank meetings next week. This is the picture then for stocks. The Spanish IBEX down by 0.3%. The FTSE showing just a little bit of weakness. This is the other side of that yen trade. So the yen gaining and the dollar weakness, perhaps playing out in some influence and some other crosses, as Mark was suggesting earlier. So the euro up 0.1%, despite more continuing disappointment around the German data story. As Tom, you were pointing out, doing nothing to push back against early rate cut expectations around the ECB. This is the sovereign bonds column then. We see these yields going higher, but maybe we don't overemphasize that too much, given the extent of the drop in yields that we've seen of late, and this just maybe a small rebound in what has been a yields lower dominant story since the start of November, really, and increasing thinking about where the Fed goes and other central banks, of course, driving that. Tom, what do you see on sectors?
Yesterday, travel and leisure and autos, basic resources amongst the leading sectors. Today, it is rate-sensitive sectors that are getting punished, at least for now, as those yields do tick up, at least in the session today. Part of that is the BOJ story. Technology is currently down in terms of a rate-sensitive sector, currently down 0.5%. Autos also off by around 0.3. Banks taking a bit of a hit, off by 0.3%. We knew that the focus should also be on what's happening in energy, given that WTI is back to the lowest levels since about June. Yes, there's been a bit of a rise in prices today, but you're still, the last time I checked, below $70 a barrel on WTI and below 75 on Brent. Energy as a sector then down by 0.2%. Basic resources, we also knew this was a sector to flag, given that iron ore prices and copper prices have picked up in the session today, and indeed basic resources lifted just 0.1%. By the way, the consumer also taking a bit of a hit, down 0.5. So it's a mixed picture across these 12 main sectors. Across your benchmark in Europe, off by a little under 0.2%. The FTSE 100 off and back below 7,500, off by 0.3%. Hannah.
OK, let's think about where we are on some of these UK themes this morning. Sophia Halter-Acosta joins us from the Markets Today blog. Sophia, good morning once again. Let's start by thinking about where we are on UK assets then. And the UK 10-year yield falling below 4%. I mean, today we're seeing these yields going higher, but the trend recently has been for yields to come down as expectations build for rate cuts next year.
Yes, exactly. And people really very, very convincingly now pricing in 3 rate cuts from the BOE next year. The BOE would essentially be the last central bank among the Fed, the ECB and the BOE to cut. But those kind of bets on interest rates coming down next year, that's really kind of feeding through global markets. We were thinking that we'd be staring at this chart for a very long time, the 10-year yield, looking at when it would cross below 4% for the first time since May. And it was just the jobs report yesterday that did it in the US. So it's not really a UK story again, but it's really feeding through. And we're likely to see lower yields when that story comes through again.
Yeah, in the session today, yields are up, so taking a bit of a cue from what's happening in the Treasuries. 5 basis points on the 10-year here in the UK, but you're still below that 4% handle, just by the thinnest of margins. The Bank of England, we had the report coming out yesterday, some comments from the governor, and a warning around the private credit markets here as well in the UK.
Yeah, so I found this incredibly interesting because Andrew Bailey was saying actually that there's these dark corners of private equity, private credit that could pose a risk to the financial system because there's so much leverage there. And then when Phil Aldrich, our very own Phil Aldrich, asked him in the press conference whether it makes sense then for the government to push pension money into private equity, because that's essentially what the plan is when you're seeing these risks. Andrew Bailey slightly dodged the question, but said these are 2 very different ideas, because one is leverage, that's the risky part of the market, and the other one is the real economy, according to Andrew Bailey, and that's where the government wants pension money to go in. But the leverage part of the market is actually the most profitable. So, I do think there's very interesting tension there, because you do want to drive money into that, but essentially that means more risk.
Interesting flagging of some concerns from the pub and the retail sector in the UK, but not around demand concerns. This is around their cost base, isn't it? This is around what we heard from Chancellor Jeremy Hunt, putting up minimum wages, and therefore this kind of sector really exposed, if you like, to that. Clearly a lot of workers will be pleased with the higher pay, but this will have an impact, we're hearing, from the retail sector.
So exactly. So retail sector has just kind of gotten over the higher input prices when it comes to food and energy, and now they're warning that actually higher wages will eat into their profitability and also their capacity to employ. So they're saying that they might actually have to cut jobs. This will, when they've just gotten over a very tough period for the industry, this will make things worse. This was it will effectively impact 3 million people, so this is not a small hike, but you would expect this to be the industry that's most affected. We did see a reaction in the stocks right after Jeremy Hunt announced this as well.
We talk about F&B, Sophia, and there was another story on the terminal today around potato prices, which was quite a fascinating read. I'm sure it caught yours as well. You're a Spuds fan, aren't you?
It did. Yeah. Yes. Well, in the run-up to the festive season, nobody wants overpriced potatoes.
Waterlogged fields in Belgium, apparently, putting the price of Spuds up.
They're too high.
Yeah.
Okay.
Yeah. There's a challenge. Whether Spuds, we'll get the chart up at some point before the end of the hour. Sophia Halter-Acosta, thank you very much indeed. And some of the things to watch: the reaction, of course, from the BOE, the warnings around private credit, but also the challenges in the F&B space potentially here in the UK. You can get more, of course, from Sophia, the rest of the team, on the front page of the Bloomberg UK website. You'll also get that potato story, I believe, on the website, or go to the terminal, of course, for all the news you can use.
Okay, here's what we're watching out for today. EU officials are in Beijing for the first in-person summit with China in 4 years. The two-day EU-China summit will focus on a range of issues with trade expected to be central to the talks, of course. At 10 a.m. UK time, watch for a finalised reading of Euro area third quarter GDP, and later at 1:30 p.m, fresh initial jobless claims data from the United States, and that will continue to build the picture around the jobs market, where we're seeing cracks, Tom, because we had the ADP data, of course, just yesterday. We're building towards payrolls, and sandwiched in between them is the jobless claims. So we'll look for something there. Really interesting. That's going to be one area of focus. But this meeting between China and the EU, really fascinating. The first time this is happening face-to-face in many years, 4 years, in fact. And we've already seen early calls from China saying, you know, about that review you're doing of our electric vehicles in your market, and calling for something different there.
Yeah, and that review is underway. It will take some time to play out, of course, but potentially really consequential in terms of the shipment of EVs from China to the European market. And of course, China is on some levels vulnerable, at least economically right now, and so it's potentially an option, or at least an opportunity for those European leaders to push their demands. But there's not an expectation you're going to get any major moves on the back of this meeting. But as you say, still consequential. First time they've met face-to-face in 4 years.
Yeah, really interesting to watch bond markets as well today. We've talked a lot about the Japanese story around the BOJ, and expectation building, even if it is just only a tail risk, as Mark was pointing out last hour, for that meeting in December this month to be live from the BOJ. And he was also flagging a really disappointing 30-year debt sale, and some on the sort of bond market team here at Bloomberg watching the rest of the bond markets, then Spain and France to conduct their final bond sales of the year. So we'll watch to see if there's a read across from the sort of fairly dramatic moves we've seen in JGBs into other markets.
And to your point, the pricing, the market pricing, you had about a 4% chance of a quote-unquote live meeting in December. That's moved to around 45%. So that's been really dramatic just in the last 12 hours or so. And then there's the global impact of potentially funds flowing back to Japanese assets in a high yield environment. So certainly one to watch next week amongst all those central banks.
Yeah, coming up on the programme then, major carriers fly lower after a JP Morgan downgrade. We will check those for you, and we'll get other stocks that are on the move this morning. This is Bloomberg.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight, because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Welcome back. This is Markets Today. 11 minutes into a trading session that is actually a little negative for European stocks. We're down by 0.3% on the stock 600. The FTSE down around 0.4%. So modest losses. US futures actually pretty flat. We're getting a look there at some of the retailers, which perhaps will be a feature of our next segment. Joe Easton joins us from our equities team to take a look at some of the stocks that are on the move this morning. Joe.
So starting with these airlines, Anna, they are getting slammed in the opening moments of trading. Air France and Lufthansa down around 5%. Lufthansa coming up slightly, and IAG in London, the owner of British Airways, also hit. JP Morgan going underway. All three of those major airlines citing overcapacity and a weakening economy. They had buy ratings on Air France and Lufthansa yesterday, but they downgrade them this morning, so we're seeing them getting hit. They are more positive on the smaller airlines, including Ryanair. They're neutral on that one, but we're seeing it feed through. As I say, all of the airlines looking pretty weak today, some dividend concerns for them as well. The seatbelt light is well and truly on for that one today. The producers just said that one in my ear. I was going to go with investors in the brace position, but we'll flip over before I think of any more, and we'll look at Vodafone, which is also down today, down 1.5%, as Exane BNP Paribas recommends selling that stock due to competition concerns and also weaker cash flow as the company exits some units in Spain and Italy. So that one, a weak one today. One that caught my eye was Adyen. This is the payment processing firm that fell 40% a couple of months ago. Surprisingly, Jefferies has a new buy on that one. They say avoid Worldline, the big peer, but they obviously see a bit of a pricing opportunity in that one. So that one rising today. Games Workshop, the maker of Warhammer, a surprising profit warning from that company. It has been one of the best performing stocks in the UK over the past few years, but analysts saying they're very surprised about the extent of the slowdown heading into the crucial Christmas period for all those tabletop game players. For that one, so that one's down sharply. Watches of Switzerland, the weakness is also in the UK. The US business is pretty strong. Rolex is their main business, of course. In the US, it seems to be okay, but the UK showing some weakness, again, before the Christmas period. Not a great sign on either of those as we head into the holiday period. We'll flip over and look at a couple of bits of M&A. Smart metering up 42%, the latest UK mid-cap company to get a takeover offer. We had Hotel Chocolat, we had Restaurant Group, City Pub Group. The latest one is a company that puts smart meters in your house to let you check your electricity bills. KKR bidding for that one this morning in private equity. I think it's probably best not to look at your energy bills at the moment and just let them tick over. But anyway, Kin & Carter, now this used to be called St Ives. It's another one that's got a takeover bid. It was a printing firm flipped into digital advertising, digital media. That is a 20% premium, but the stock only rising 10%, potentially some concern that that might not actually go through, but that's both M&A. Sanofi over in healthcare, they are doing their important Investor Day, predicting that some of their experimental drugs may actually hit 10 billion euros worth of sales within the next few years. So that one being taken pretty positively, up 0.6%, and a big profit warning again. We got a couple of weak ones from the UK. Future PLC, it's a magazine publisher. They do things like Country Life and Marie Claire, magazines like that. Down 18%, the worst performer in London. Sales weakness for them, and that one sliding, as I say, double-digit declines for Future PLC.
Joe Easton from our equity team, thank you very much indeed. I don't know, Anna, I don't really have an image of Joe Easton as a Warhammer fan. But
no,
maybe
he talked about it with great confidence, though.
He did. So maybe he's got a little line of those little characters somewhere
yes.
In his new apartment. Joe, thank you very much indeed. Let's get back to the macro story and the US data story. US Treasuries taking another leg higher yesterday. That's changed today as a slowdown in private sector job creation encouraged traders to bet on Fed rate cuts. We've heard that story, and it's certainly coming through in the pricing. This comes ahead, of course, of key labour market data tomorrow. Non-farm payrolls due at 1:30 p.m. London time. Joining us now is Tessa Mann, Director of Global Multi-Asset Strategy at WTW. Tessa, thanks for joining us in the studio. Good to have you here. You are cautious, it seems from your notes, on the soft landing scenario. I wonder, short term, do you bake in, how much concern, how much caution do you bake into your strategy as we lead up to the non-farm payrolls print on Friday and Jay Powell and the Fed next week? Is there going to be pushback from the data? Is there going to be pushback from Jay Powell himself? Are you cautious at this point when you think about your short-term strategy?
Yeah, good question. So as we look into tomorrow, I think what I'm really interested to look at is the market reaction to that. So we are not running a very short-term strategy. We're looking kind of the next 3, 6, 12 months as to what's really pertinent. And what we've really seen so far is that as we've seen any weakness in the jobs market, that's translated to an expectation of lower inflation, which has really been the main topic over the year to date, as we know. That's likely to pivot into a discussion on the impact on the consumer and also on the impact on growth. We've not really seen that so much so far, so that's what I'm interested to see and when we're likely to see that more next year.
So do you think that the market has become too preoccupied by a positive connection between rate cuts and stocks, rather than thinking about if this is all quite growth negative, then what does that mean for stocks?
Absolutely. I think if we look at the kind of market price reaction so far, if we see any kind of expectations of a more dovish Fed, that's coupled with a price reaction that indicates an expectation of a continuation of this current cycle. Clearly, that is a plausible path, and we know there is strong underlying economic fundamentals, particularly in the US. But what's really pertinent at this time is the real extent of the rate hikes that we've seen so far. Jerome Powell himself has clearly signaled that the full impact of that won't yet have been seen on the US consumer. And if we look at kind of softer data, we are beginning to see that US consumer slow down. So the current forward estimates of, a reacceleration of earnings into 2024, whilst plausible, could come under pressure as we see, the consumer weakening and also companies grappling with the higher interest expenses.
And we want to get your views on the earnings picture and the sectors in terms of where to position. But just to be clear, in terms of your base case at this point for how many cuts come through for 2024, where do you land?
Yeah. If I'm looking at the market, I think given the potential downturn, it's not too far off actually on a kind of weighted basis if we did see those cuts that might come through in more of a downturn. Actually, if we did get more of that soft landing, though, I think the market is a little over-optimistic in expecting that the Fed could have cuts when we do still have that risk on the horizon of a reacceleration of inflation. So I think the Fed is unlikely to cut to that extent if we do see a continuation of this cycle.
Okay, so where do you invest around that? As Tom was saying, let's get into some of the strategy then.
Yeah.
Clearly some uncertainty about whether we get a softer or harder landing than in the US, but given that, how are you investing?
Yeah. So in terms of kind of equities, we have got a moderate underweight position in our multi-asset portfolios. Some caution we would advise going into next year. Clearly, there are still some economic, strength, so that is a moderate position. If we look at equities relative to bonds, government bonds still are somewhat more attractive. A 2% roughly real yield, still very much kind of top end of what we would expect, particularly looking at the underlying fundamentals. So a bit more in bonds, a bit less in equities. And within equities, we can still see Japan in particular as being the bright spot.
Yeah, and on Japan, big story today, of course, around speculation that maybe that end to negative rates comes through potentially next week from the BOJ. We'll see if indeed that does happen. Do you start to position around a slightly more hawkish BOJ? Is that something you would start to pull the trigger on now?
Yes, certainly. I think the Bank of Japan's policy will come and is coming under pressure, as we can see. The yen has continued to struggle, especially with those carry dynamics against the US dollar over this year. That is something that we're positioning for in terms of, a higher yen going into 2024 as well.
Okay, Tessa, thanks so much. Thanks for joining us. Tessa Mann, Director of Global Multi-Asset Strategy at WTW. We will have more on the market straight ahead. This is Bloomberg.
You think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Okay, this is Markets Today. Happy Thursday. We are 23 minutes into the European trading day, and you're seeing losses of 0.3% across the European benchmark. Let's go to another really intriguing story around the airline space, a story that Bloomberg has led on from the outset. And the UK's top fraud authorities have made an arrest after raiding the London home of an aviation industry executive in the early hours of this morning. It's a case of suspected fraud relating to the selling of fake airplane parts. Let's find out more, get the details with Bloomberg's Kate Duffy. Kate, what is the latest?
So the Serious Fraud Office yesterday afternoon said they had raided an address and arrested an individual in relation to AOG Technics. So that's the London-based firm accused by aviation regulators of supplying engine parts with faked documents. So the SFO said it's launched an investigation into this, and the probe deals with or involves the supply of parts to airlines in the UK and other countries as well. So the person has been arrested over allegations of suspected fraud and is currently being questioned. And the SFO said it's now working with the UK Civil Aviation Authority and other regulators to try and work out what's happened. But this is really a significant step because it's the first time that an agency has pursued criminal action over these specific bogus airplane parts, and something which Bloomberg has been reporting on since the summer.
Yeah, absolutely. 3 months of coverage here then. We've already heard from some airlines about the impact that this is having on them and the investigations they're doing. So sum that up for us. What is the impact on the aviation sector?
Well, one thing is clear. This isn't just related to one corner of the world. This is worldwide. Airlines dotted around the world have come out and said that they've found these suspected engine parts in their aircraft. The latest one was Ryanair. So last week, CEO Michael O'Leary told us that a suspected component had been found on 2 of their jet engines, and others such as Virgin Australia, Delta, Southwest have all disclosed that they found these suspected engine parts as well. And the SFO confirmed yesterday that AOG parts have been supplied not only to UK airlines but also maintenance suppliers. So this really is a global scandal, and one that the SFO has called far-reaching.
And an aviation industry that continues to grapple with that global fallout that you illustrate for us. Kate, thank you very much indeed. Kate Duffy bringing us the latest in terms of the response to those parts being fed into the aviation industry. Right, coming up, the Russian President Putin, of course, completing his tour of the Gulf as he defies efforts to isolate him on the world stage. We're going to have more on that story next as your European futures point lower by 0.3%. Of course, energy was a big part of the reason for that visit. And you're seeing Brent trading at $74 a barrel, up 0.5%, but WTI remains below $70 at $69.72. Plenty more coming up. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European stocks decline as global growth concerns weigh on markets. Germany's industrial production unexpectedly shrinks, adding to evidence that Europe's largest economy is continuing to contract. Japan's 10-year yield jumps as comments by BOJ Governor Kazuo Ueda fuel bets on an end to negative rates. And President Xi Jinping tells EU leaders China wants to be a key partner on trade. Officials from the two sides meet face-to-face in Beijing for the first time in 4 years. Tom, European equity markets a little weaker this morning then as we get closer to the end of the week, and that non-farm payrolls data still the big data point to come, but a lot of focus on Japan today.
Yeah, absolutely, in terms of expectations that maybe the BOJ is in play, that meeting next week, given the commentary we've heard from senior officials, including, of course, the Bank of Japan governor, around the challenges of maintaining their current policy. So will they indeed end their policy of negative rates next week? That would be consequential, not just for Japan, but, of course, for global assets. So, yes, European stocks taking a breather after 3 straight days of gains. Currently, the benchmark down 0.3%. The heavier selling coming through for the FTSE 100 here in the UK, losing 33 points, down 0.4%. Over in Germany, that softer data that we talked about in terms of industrial production, just building out the picture of a weak German economy, currently down 43 points, down 0.3%. And those import prints out of China, frankly, very disappointing. Pretty grim picture in terms of the soft softness coming through, what it signals about domestic demand in China, and that links certainly to the corporate space in Europe. Let's flip the board and have a look at the sectors, Dan, and the breakdown coming through. You've had some downgrades for the airlines, and those airline stocks are certainly weighing, but so is Games Workshop here in the UK, one of the biggest, if not the largest, loser across the European space so far in the session. The consumer sector is going down 0.7%. Just one sector out of the 12 that we're looking at here, food and beverage, gaining 0.1%. But the losses coming through, again, for basic resources, despite iron ore and copper prices picking up this morning. Concerns about China, no doubt. Basic resources, a sector down 0.5%. Energy taking another knock. Yes, oil remaining under pressure. Prices have ticked up a little bit in the session, but of course, you remain at around June lows for oil prices, below $70 a barrel on WTI, and energy down 0.4%. Technology vulnerable to those higher rates. Yields have picked up in the session today. Tech down 0.4%. Autos also taking a bit of a hit, off by 0.4%. And banks, financial services, also lower between 0.5 and 0.8%. Losses then across the benchmark of 0.3% at 468 on a European benchmark. Anna.
Okay, let's pivot to some geopolitics. And the Russian President Vladimir Putin has met with the Saudi Crown Prince Mohammed bin Salman as part of a rare foreign trip since the invasion of Ukraine. Putin earlier held talks with the UAE president in Abu Dhabi, defying US and European efforts to isolate him on the global stage. Let's get now to Dana Kraish, who's Bloomberg's Middle East breaking news editor in Dubai. Dana, good to have you on the program. So how successful was this one-day trip then to your region, to where you are, by President Putin from his standpoint?
We think that the trip was pretty successful. This is Putin's first visit to the Gulf countries and to the region as a whole since he ordered the invasion of Ukraine almost 2 years ago. The trip, the visit, the ceremonies that were held for him, how he was greeted, the flyover in Abu Dhabi and elsewhere, of course, just shows that the message that he wanted to send was successful. He is still relevant. He's influential in the diplomatic arena, despite attempts by the U.S. and the allies to isolate him over the war in Ukraine, of course. Saudi Crown Prince Mohammed bin Salman, during his meeting with Putin, did have a very significant quote about him. He called him, open quote, a special and highly esteemed guest in the kingdom, close quote. This does show how strong these ties are between the two. Saudi Arabia and the UAE have remained relatively neutral towards the war in Ukraine, and there are a lot of Russian companies and nationals that have moved to the UAE since Russia's invasion of Ukraine, and they found this to be a very safe place for them.
You have to pinch yourself a bit when you see these pictures of the Russian president. Remind yourself that, of course, they did invade a sovereign nation, but somehow the UAE and the Saudis can just look past that. Talk to us about the importance of that relationship, then, for Russia as it heads towards a third year of war with all the bloodshed in Ukraine.
He's trying to send a message that he's not as isolated as the U.S. and its allies want him to be. The visit to Saudi Arabia was very important, right? I mean, if it was coincidental or not, we don't know, but it does come after the OPEC Plus alliance said they would not only extend the production cuts, the oil production cuts, but deepen them as well to prop up prices. This is very important for both Saudi Arabia and Russia. For Russia, they have to continue funding the war in Ukraine. For Saudi, it also needs funding for its massive economic transformation program. And so for both, they need to show and maintain a united front in terms of the energy sector as well. And so the trip was very significant, especially him meeting with Saudi Crown Prince Mohammed bin Salman.
Talking of meetings, we know that President Putin is set to meet his Iranian counterpart in Moscow today. So this one on home soil, but another friendly state, perhaps. What are we looking for there from that encounter?
Iran's President Raisi, yes, is expected to be in Moscow today, and Putin will meet him. Putin, in Saudi and in the UAE, he did discuss the Israeli-Palestinian conflict, which Iran is very involved in, given that they support Hamas, which is battling Israel in the Gaza Strip. It also comes as the UAE plans to submit a UN Security Council resolution calling for an immediate ceasefire. This also, of course, comes after UN Secretary General Guterres invoked his most powerful tool to get the Security Council discussing the situation in Gaza and, of course, calling for an immediate ceasefire. So this might be part of Iran's diplomatic efforts to get things going, and, of course, the Arabs as well.
Dana, thanks very much. Bloomberg's Dana Kreisch with the latest on that geopolitical or those geopolitical encounters. Let's get to some of our other top-read stories on the Bloomberg terminal this morning. Senate Republicans have blocked $66 billion in emergency Ukraine aid, heightening the risk that U.S. funding for Kyiv's war effort will dry up. No Republicans supported the procedural motion to consider the bill, which failed by 49 to 51, well short of the 60 votes needed. UN Chief Antonio Guterres has dramatically escalated his call for a ceasefire in Gaza, invoking the most powerful tool available to a Secretary General for the first time in 5 decades. Guterres sent the letter under Article 99 of the UN's Charter, which allows him to bring any issue seen as threatening international peace to the Security Council's attention.
Meanwhile, Bloomberg has learned that Elon Musk's SpaceX has started discussions about selling insider shares at a price that values the company at $175 billion or more. Sources say the startup is discussing a tender offer of up to $750 million. They also say SpaceX is weighing offering shares at about $95 apiece. Bloomberg has learned that Apple is readying new models and upgrades for early next year to stop a sales slump. Sources say the new iPad Air will come in 2 sizes for the first time, and the Pro model will get OLED screens. The MacBook Air will also feature the speedier M3 processor. The Mac and iPad combined account for 15% of Apple's revenue. They've been hit hard by a decline in consumer tech spending.
On Capitol Hill yesterday, Wall Street bosses took their most direct aim yet at Washington's plans to force them to set aside more cash as a buffer against losses. Executives tried to reassure lawmakers that Americans' assets are safe in their hands.
We had 10 years to do this, and it's shocking to me that we're sitting after 10 years and we're talking about what's it going to do for small business, and we have to analyze it today.
It has much more an impact than people think. Additional increases are wholly unnecessary.
Almost every element of the Basel III Endgame proposal would make lending and other financial activities more expensive.
As it stands, the proposal would increase the cost of capital and borrowing across the economy.
As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market.
It'll particularly diminish mortgages for lower income people.
Ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis.
It was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
Some animated language there, some firm opinions. Let's bring in Bloomberg's Jenny Serene from our finance team. Jenny, really fascinating exchanges there. Clearly the message is, well, they were talking about Basel III Endgame, which sounds amazing. If that's a film, I'm digging it out over the weekend.
Please don't, Anna.
I'm not sure anyone's made that one just yet. But hurting growth was the big message, I suppose, there. What were you taking away from these Senate hearings?
No, I think that's absolutely right. So basically, U.S. regulators have announced that they are planning to implement a series of really stringent capital requirements on these banks in the coming years. And basically, since these were announced back in July, Wall Street has been on a huge lobbying campaign to try to put a stop to that. And so you just saw more of that yesterday, really, with every single CEO kind of coming out and really not pulling any punches when it comes to talking about, how much they think this will hurt economic growth, how much they think this could, impact the end consumer. You really saw them trying to draw on the American public's heartstrings. So you heard Jamie Dimon there talking about how this will limit your access to mortgages. You had David Solomon saying, this could impact the airlines and how much they have to spend on jet fuel. So really just a wide variety of end use cases that they're trying to kind of show this is what this could mean for us.
Yeah, you've got to wonder how well that lands or not with the American public. Meanwhile, talking to Jamie Dimon, take another pop at crypto.
Absolutely. It was kind of interesting. I mean, him and Elizabeth Warren on the same side for maybe the first time. So Jamie kind of came out really hard on crypto, saying that he thinks the government should put a stop to all crypto activity, which is not so surprising for him. He's kind of been a longtime antagonist of the crypto industry. But Elizabeth Warren yesterday was someone we really expected to come out swinging against these big Wall Street banks, and instead she was actually asking them for help and to support her as she tries to introduce more regulation on this industry.
Okay, Jenny, thanks very much. Bloomberg's Jenny Serene with the latest on the financial services sector. Coming up on the programme, tough negotiations on artificial intelligence. The EU Council postpones its briefing on its landmark AI Act. Talks around this have been going through the night. We'll get details next. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 44 minutes into your European trading day. You're seeing losses across the European benchmark of 0.3%. Bottom of the list across your sectors, real estate and travel and leisure. Let's get to what's happening within the regulatory space and AI. The EU Council has this morning decided to postpone its briefing on artificial intelligence rules. The policies are poised to become the most comprehensive regulation of artificial intelligence in the world. Let's get the details then from Bloomberg's tech reporter Aggie Cantrell in Berlin. Aggie, what is the significance of this deal that they have yet to reach, and where are we in terms of the sticking points in these negotiations?
Yes, so essentially, as you say, they have already postponed a briefing that was supposed to be around 8:30 this morning because there are still quite a few sticking points. As far as we understand, they have come to an agreement on controls around generative AI tools like the likes of ChatGPT and Bard, Google's product in that space, but there are still a lot of points of negotiation. This is essentially one of the first major forms of regulation of AI. It's something that the EU has been having in the works since 2021, since well before the current AI boom that we're seeing across the tech sector. But that has, of course, these current new tools that have been unleashed on the market have, of course, impacted the way that this legislation is going to go. And they have seen a lot of issues with the likes of ChatGPT that they want to also tackle in this legislation. So essentially, they're doing it on a risk-based approach. They are looking at certain technology that they are going to say is very high risk, like, for instance, social scoring technology that they think will most likely be completely banned. But then there are other technologies that are seen as high-risk technologies, but still being able to be applied in certain contexts and with certain limitations. And for instance, with the limited risk that you see with the likes of ChatGPT, they still will require a level of transparency for the user to know when they are engaging with a chatbot of some sort. And so this risk-based approach also means that essentially for Europe, there is this attitude that there are certain applications which are more significant and more dangerous for the general public than others.
Okay, so a lot of focus then on the ChatGPTs and the Bards of this world and what it means for them. But I think from a European perspective, also concerned about what it means for smaller European tech businesses. What are the implications?
Yes, so that's a big concern for Europe, because if you look at that is essentially a sticking point within the negotiations. We have France and Germany that have, in the last year or so, invested a lot of attention into their own real LLM products that they could come out. We're looking at Mistral AI in France and Aleph Alpha in Germany. These companies are being held up as potential European answers to the likes of OpenAI. And so there is a concern that this sort of legislation, this sort of regulation will essentially limit the development of European technologies in this space. And also, it's also a question about the application. It's all about the application of AI. That is a focus of this AI Act. And a lot of other startups that are popping up at the moment are looking at how to apply AI. And the question is whether or not this regulation will limit the ways in which they can apply it and will limit the development of an AI ecosystem within the European tech sector.
Yeah, particularly as the US has no equivalent when it comes to a regulatory framework like this. Really significant. Bloomberg's tech reporter Aggie Cantrell on the details around that deal that continues to be hammered out in Brussels. Thank you. Staying on artificial intelligence and the hardware component, AMD has unveiled a new line of AI accelerator chips as it takes aim at a market, of course, dominated by NVIDIA. CEO Lisa Su spoke with Bloomberg's Ed Ludlow on the red-hot market for the chips and their ambitious forecast for the industry.
If you look at training performance, we're very, very competitive. Let's call it, it's a toss-up. When you look at inference performance, we're 1.4 to 1.6 times better. And what that means is, if you're running these models, you can actually run more models or you can run larger models, with MI300. And right now, the key to AI is GPU compute. I mean, that is absolutely what everybody says. And so we're here to provide lots of GPU compute.
You've had the confidence to dramatically alter your forecast for this market, for AI accelerators. You're saying a total addressable market of $400 billion US in 2027. In August, just in August, you said it was 150 billion. What has changed?
Yeah, and really the way we look at these things is we usually look at these things on an annual basis. And so, when we were, doing our plan for 2023 and beyond last year, we thought that this year there would be about a $30 billion market, and it would grow 50% compound annual growth rate, so be about 150 billion in 2027, which frankly was very, very large. But what's changed is we can all see what's changed, right? People need more compute. They're installing more. The numbers for this year are probably closer to 45 billion. And when we talk to customers, when I spend time with our partners, and what they tell us is the technology requires more compute. And so we now believe the total market for this, it's upwards of 400 billion in 2027. It's huge. There's no one size fits all. There are going to be multiple solutions. There are lots of good solutions out there today, but we believe the AMD capability is very significant, and so we're excited about it.
It was interesting to see on stage how MI300X manifests itself in the real world, but you'd already guided us that it will likely be the quickest AMD product to $1 billion. There were sections of the market in the street that said your forecast of $2 billion of sales for MI300X in 24 was conservative. If you're saying that the total addressable market by 2027 is now 400 billion, then is that 2 billion forecast for next year specifically for MI300X conservative, as the market thinks it is?
Well, I think you have to take a step back and just look at how this technology is evolving. So, we did update in our last, conference call to an expectation of about 2 billion in 2024 for our data center GPUs. It's a very early estimate. I would say, we have clear line of sight to that. But, what people ask me is, there's much more customer demand, definitely, and there's also, significantly more supply because we've had to prepare the supply chain so that we're ready to ramp. So we'll update as we go along. We are, definitely on this path to ramp MI300 the fastest as anything's ever ramped at AMD. And, I view this as a multi-year opportunity for us.
That was the AMD CEO, Lisa Su, with Bloomberg's Ed Ludlow, talking about high expectations for the sector. We'll get back to the markets shortly. This is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg. This is Markets Today, 54 minutes past 8 here in London. So European stocks on the back foot this morning, down 0.4% or so. E-minis, though, stateside, down just 0.1%. And NASDAQ futures actually flat to positive. So that tells us something perhaps about where we go later on today when US players are at their desks. Tom, let's have a quick check on some of the interesting movers in the market today. And one of those is around the aviation sector. You see a number of airlines trading lower today. Air France KLM down by more than 6%. Lufthansa down by more than 4%. JP Morgan has turned more cautious on certainly the network names, that's in contrast to the low-cost airlines, and has double downgraded, so down 2 notches, Air France KLM and Lufthansa, and it's also moved IAG down by 1 notch. So these 3 stocks are now underweight. That's what they're doing on the downgrade side. They've also upgraded Deutsche Post. But in terms of the story around aviation, they're saying there's potential for large capacity increases to bring yields down against a backdrop of weaker economic growth. And that's a story we've seen play out in the aviation sector in times past. So muscle memory there.
I don't quite know how we pivot from airlines to tabletop games, but we're going to do that. Games Workshop is actually the biggest loser across the session so far in Europe, dropping a little over 9% on disappointment around its earnings. But before we get there, we're showing you smart metering systems because this is a story about a private equity bid for this UK listed company. You can see the share price upside reflecting the premium coming through from that bid by KKR. Again, a reminder, the broader story that private equity sees value in UK equities, even if the public markets are not pricing that value in as yet. But SMS, as you can see, jumping on the back of that. Games Workshop, as I mentioned, the biggest loser of the session so far, down 9%, disappointment around the earnings.
And now we finish with another story that's entirely different. I don't want to make light of it because it is about climate change, but it's also about potatoes, which ahead of Christmas just feels inherently amusing. But climate change hits potatoes, making Christmas even pricier. Seasonal prices in Europe soar to the highest in at least 14 years, which certainly is not funny, nor are the causes. Farmers in Belgium, France and the UK have had to sideline tractors because, as you referenced earlier, Tom, waterlogged fields in Europe.
You could pick them up, 100k of potatoes back in 2017 for about €4. They're now about €34. There is a futures index on potatoes.
Under NI potatoes.
So you can mash that all together, get a peel on it, I don't know. The spuds...
Where's Joe Easton?
We need Joe Easton to really nail this, but the potato story is real. There it is. There's plenty more coming up. Stay with us. You can get insights from us, the rest of the team. Stay with us. This is Bloomberg.
the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua with the conversations that matter, and here's what's coming up on today's program. European stocks lower, and Japan's 10-year yield jumps the most in a year. With increasing bets, the BOJ will scrap the world's last negative interest rate regime as soon as this month. The latest German industrial output data adds to evidence that Europe's largest economy is on track for a recession, with production in October shrinking unexpectedly. And later this hour on Bloomberg UK, we also take a look at the British government's green record as negotiations continue at COP28 in Dubai. So let's take a look at the European markets map. A lot going on actually in today's trading session. A lot of the focus, of course, is on Japan soon scrapping the last negative interest rate regime. What that means, it probably means that we'll have repercussions across the board. Now, if you look at global markets, they're definitely moving in response to that. You can see European stocks actually opening a little bit lower. I'm also looking at the yield on the 10-year Treasury, which is always significant. It added some 7 basis points, the dollar falling for the first time in 4 days. So it's all about the Bank of Japan's December policy meeting, and traders now see it as a live event after comments from Governor Ueda and his deputy Ryozo Himino. Now, joining us for more on the markets is Maya Bandari, Global Head of Multi-Assets at BNP Paribas Asset Management. Maya, so great to see you. Thank you so much for coming on. I mean, Japan kind of changes everything if they actually go ahead and loosen. What are you expecting from them?
Well, as you know, we've had a pretty long duration bias. I think the last time I was here, I was talking about how long duration was our highest conviction trade. And I think Japan sort of sits aside from that. And actually, just yesterday, we have gone short JGBs because I think Japan is in a different place to the rest of the world. So I'm not sure that it changes that global narrative. I mean, I think we reckon Japan is positioning itself to start hiking interest rates early next year, just as other G10 central banks are going to ease. I think Japan wants inflation to be a little bit higher. They've effectively abandoned yield curve control. So I think from an investor's perspective, the risk of the Bank of Japan really squeezing you out seems a little bit less. And then, of course, there's the whole benefit for Japanese investors, given the hedging costs from owning global markets relative to JGBs. So actually, we sort of saw JGBs as a bit of an opportunity because JGBs rallied along with everything else in November, and yet strike us as being in quite a different place, actually.
Unbelievable to think that we're, early December, kind of going towards the end of the year. Is it still going to be inflation, central banks driving everything in markets, or is there a point where we see actually earnings depression?
Oh, that's a great question, because I think duration and expectations around interest rates have been the driver for markets. Now, for us, going into 2024, although we have clipped back some of our long duration with that short JGB trade I just described, we remain long duration. That is a high conviction view, particularly in U.S. real yields at the longer end, EM local, European investment grade. So we do think that carries on. But on the earnings side, we are a little bit more cautious. So we're still at the still underweight equities. And I think when we look at what we got from this earnings season, in Europe, for example, a miss on quite weak trailing earnings, but also really weak forward guidance, and that's something that should drive forward-looking asset market returns.
And Maya, if you look at some of your conviction calls, so you're cautious on equities, especially in Europe, but modest longs in defensive markets. What's the problem with Europe? Because a lot of the things are cheap. Do you worry about a deeper downturn than elsewhere?
Yeah, I mean, you're right. Things are cheap, but when we look at the expected level of earnings for the consensus, for example, we're still in sort of single digits, mid to high single digits. Now, the European macro setup, as I think you reflected earlier on, is pretty weak, and European companies are highly levered to that, given the operational leverage of these companies, and so earnings, to our mind, could easily fall by the amount that they're currently projected to rise by. So hence Europe is an area of some caution for us. Against that, we sort of have, we like, modestly like, I should say, because they're very small positions, but we favor defensive growth in the US. I'd call defensive value in the UK, because the UK market's also very cheap, but a bit more defensively composed. Yep. And we like some idiosyncratic emerging market stories as a bit of a diversifier.
I mean, that's important. If you look at emerging markets, I don't know whether that's linked to also some of the focus, for example, on green technology and some of the money transfer, which is still small, or is it just on structural benefits?
Well, I think, again, it depends which emerging market we're looking at. I mean, I think one of the markets that we quite like, for example, is Brazil. And I think in Brazil, you could point to cyclical support from a macro perspective, but you'd also say, well, look at how far earnings expectations are rising, look at the earnings revision ratios, and then look at how cheap Brazilian equities are relative to global equities. So that's how we would think about some of those markets.
And Maya, is there anything else in the emerging markets? Again, how do you play it? Is it equities, currencies, or bonds?
So we like EM local bonds as part of that broad favorable disposition towards duration. These are positions we were building up as we had quite a savage sell-off just not so long ago. So we like EM local bonds. We're neutral on emerging market equities overall, but as I said, have a modest bias towards some of the LatAm markets like Brazil. We did like China earlier in the year, but we've stepped away and stick at neutral, because there again we see a lot of value, but the trigger to unlocking that value is less clear to us. It's been interesting to see how little in some ways equities have responded to some stimulus announcements coming out of the Chinese that in the past you would have had perhaps a bit more of a response.
What do you do with China right now? In terms of investments or companies that actually have exposure to China?
So China, as I say, we're neutral overall. We like Brazil, that benefits from China, but has its own domestic story going as well. And of course, EM local, which is a play on rates rather than equities, and where China has a less significant impact, if you will, right? So China is a third or so of equity indices, 10% of EM local.
And finally, Maya, what do you do with the UK? So again, we're seeing an election probably in the next, well, we don't know, but certainly by the time that January 2025 comes along. Yeah. And so there's a lot of political factioning. What does it mean for assets and stock markets?
So on the UK, we actually liked gilts relative to some of the European markets like bunds, and as we had a really quite powerful move in those spreads, we've taken profits on that, so we've stepped away from being long of gilts. But as I said, we quite like UK equity markets within a cautious view on equities overall, because UK markets are, number one, very attractively valued. Number two, offer you a bit of defensiveness, both from a sector composition, but also from the yields you get on some of these UK companies, and policy, particularly on the monetary side. That discount rate picture we think could be quite positive for UK risk assets.
Maya, thank you so much. As always, Maya Bandari, they're Global Head of Multi-Assets at BNP Paribas Asset Management. Coming up, China's President Xi Jinping calls for more cooperation with the EU. What does this mean for the bloc's relationship with Beijing? More on that next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The conversations that matter, the insights that you need. This is a Pulse, and I'm Francine Lacqua here in London. Now, the Chinese President Xi Jinping has told European Union leaders that the two sides should step up cooperation. Well, Xi met with the Commission President Ursula von der Leyen and the Council President Charles Michel in the Chinese capital earlier today. Now, let's bring in Bloomberg's Alan Wan. Alan, good morning, good afternoon for you. What are the major disagreements between China and the EU, and are they different from China and U.S.?
Well, actually, there are a lot of the disagreements are similar to the U.S. You've got, the trade, of course. You got human rights. You got the war in Ukraine. But there's one major one disagreement that differs, and that's the fact that with the U.S., there's a major defense and military component to their tense relations that you don't necessarily see in Europe. So the biggest bugaboo for the EU is actually it's a trade deficit with China. It's $400 billion. Right now, well, last year anyway, it's huge, and it's so big that von der Leyen says that it's unsustainable, and that's really one of the reasons why the EU launched a probe into Chinese EVs for possible subsidies. Trade is such a hot political issue, and it's probably one of the reasons why Italy said that it's pulling out of the Belt and Road, just because its trade deficit with China has ballooned since it signed its pact with China on the Belt and Road. So that's probably like the biggest bugaboo. But then you got other issues like Ukraine. Of course, the EU is going to ask China to sort of prevent Russia from circumventing sanctions. And EU also wants China to do more, have some more tangible progress in terms of providing more market access to EU firms. The EU Chamber of Commerce president in China said today, which I agree with, like one way they could do that is by allowing European firms to be able to bid for massive public procurement projects in China.
So what does this mean for the EU-China relationship going forwards? And frankly, we saw actually Italy get out of the Belt and Road, and that felt very significant.
Yeah, I mean, it is. But you know something? China went around and said that, okay, well, Italy wants to pull out, but we're still willing to work with Europe. Europe has a sort of like its own Belt and Road called Golden Gateway Project, and China says that it's willing to work with EU on sort of infrastructure around the world, except in strategic areas. But overall, the relationship is going to remain bumpy, mainly because of trade. China has said that it considers the EU probe into Chinese EV subsidies as no more than trade protectionism. And it's one issue that China is not going to willing to forego, just because subsidies, are a major plank of China's economic development strategy. That said, I think that there are some positives as well. In the last few weeks, we've seen China allowing citizens from several European nations visa-free travel, and that's going to be able to boost, exchanges between people, especially after a lot of European expats left during the lockdowns. But all in all, I have to agree with the EU Chamber of Commerce president in China, saying that deep issues stand in the way of good EU-China relations.
Thank you so much, Bloomberg's Alan Wang there with the very latest on the EU and China. Now, oil was also on the agenda during Vladimir Putin's trip to Saudi and the UAE, pretty much as expected. Now, it's Russian president's first time visiting the energy-rich region since his invasion of Ukraine almost 2 years ago. Well, Bloomberg's Dana Krajce joins us with the latest. So, Dana, what do the UAE and Saudi Arabia actually stand to gain from hosting Putin? And what does Putin's visit signify in political terms?
Hi. So Putin stands to gain a lot from this, right? He is sending a message that he is not as isolated as the West and its allies want him to be, that he's still very relevant, and he will get the massive ceremonies and the receptions like we saw in the UAE and Saudi Arabia as well. And there was a significant quote from Crown Prince Mohammed bin Salman of Saudi Arabia during his meeting with Putin, and he described him as, open quote, a special and a highly esteemed guest in the kingdom, both by the government and its people. And that shows the importance of maintaining this relationship between Saudi Arabia and Russia. For Saudi Arabia and the UAE, it's part of their diplomatic push. They want to raise their profile globally. They want to increase their soft power and become more influential in regional and global politics. And so this is them also saying, look, we can host Putin, we can host, like Saudi Arabia hosted Zelensky a few months ago, also in Jeddah, actually, not in Riyadh. And so this is part of Saudi Arabia's trying to bolster its image on the global stage. And the UAE hosts a big number of a lot of Russian companies and Russian nationals who found Dubai to be a safe place for them to be. So that is also significant for Putin to be in the UAE.
So what did the visit actually achieve? What did Putin's visit to Saudi Arabia achieve?
Whether coincidentally or not, the visit's timing comes after the OPEC Plus alliance said that they would extend and deepen their oil production cuts to bolster oil prices. So Putin and Crown Prince Mohammed bin Salman, they both discussed energy cooperation, and they need to show a united front. They want to show close coordination. They are key members of the OPEC Plus alliance and the drivers of it, and they both need oil prices to be up. For Putin, it funds his war in Ukraine, and for Saudi Arabia, it is funding and needs that liquidity to fund its massive economic transformation program. So for both, it's a big risk if oil prices fall down. So what they're trying to do is keep it up, and that image of a united front, they're hoping, and close coordination, they're hoping that would give the market kind of a sign that they would probably take a further step to do so.
Dana, thanks so much. Dana Krajce there with the very latest on Putin in Saudi and the UAE. Now, coming up, we have some lines from the U.S. Senate hearing, which is featuring chief executives from America's biggest banks. That's next, and this is Bloomberg.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Or other authorities.
Could face bigger challenges.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make. Now, on Capitol Hill yesterday, Wall Street bosses took their most direct aim yet at Washington's plans to force them to set aside more cash as a buffer against losses. Now, executives tried to reassure lawmakers that Americans' assets are safe in their hands.
We had 10 years to do this, and it's shocking to me that we're sitting after 10 years and we're talking about what's it going to do for small business, and we have to analyze it today.
It has much more an impact than people think. Additional increases are wholly unnecessary.
Almost every element of the Basel III Endgame proposal would make lending and other financial activities more expensive.
As it stands, the proposal would increase the cost of capital and borrowing across the economy.
As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market.
It'll particularly diminish mortgages for lower income people.
Ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis.
It was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
Well, let's bring in Bloomberg's Tom Metcalf from our finance team. I mean, first of all, it was quite funny seeing them all lined up like that. I mean, I hadn't really seen that before because usually it's like one or two at a time, and not all of them. What was your biggest takeaway?
Yeah, you had all 8 of the big US bank CEOs. So one was those comments we just heard then where they're all lined up, slamming, as we know, Basel III. But 2, for me, I was watching this, waiting for sort of some fiery exchanges, some sort of excitement there. But actually, largely, it was all very cordial. Even sort of Senator Warren didn't really go after them. And the banks were largely talking the same book.
Yeah, and as you're saying, there were few fire exchanges. But let's take a listen to what Jamie Dimon had to say about crypto.
I've always been deeply opposed to crypto, Bitcoin, et cetera. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case. If I was the government, I'd close it down.
I mean, that was quite punchy. It was said in, a very cool voice, but it was quite punchy.
No, exactly. This is probably his favourite topic, actually, I'd say, and he really went after them, and then you had the senators kind of agreeing. So it was this, normally you have, the senators versus the bankers, and in this case, everyone was lined up, effectively, piling in on crypto.
Any other topics that caught your eye?
Well, I did enjoy this one exchange, which is kind of also a little bit fiery, back on Basel III, where effectively, one of the senators, I think Senator Brown, was just saying, look, you guys are all out here slamming things. You're putting money up against, this thing. Is that really the best thing you guys can be doing with your time? And otherwise, I thought it was a lovely description of the regional banking crisis in the US, not as a banking crisis, but a crisis for those 3 banks in particular, which I think captures really very well that sort of crazy period earlier in the year.
Tom, why do you think the mood was so subdued? Is it because, they don't really have anything to go after the big banks right now? Or is it, do they have bigger problems to focus on?
Yeah, it was interesting. Yeah, normally you've got people kind of standing up and, making maybe some political points, and perhaps that reflects that, largely the banking industry managed to navigate the sort of earlier crises. And I think that's the other thing. Crypto is a very easy punching bag, and so when, everyone's piling in on something that everyone sees, they can maybe get a bit of advantage out of it. Just looks like happy families.
For now.
For now.
Tom, thank you so much, as always. Tom Metcalf there, who oversees all of our European banking coverage. Now let's get to some other top red stories on the Bloomberg terminal. Senate Republicans have blocked $66 billion in emergency Ukraine aid, heightening the risk that U.S. funding for Kyiv's war effort will dry up. Now, no Republicans supported the procedural motion to consider the bill, which failed by 49-51, well short of the 60 votes needed. The UN chief, Antonio Guterres, has dramatically escalated his call for a ceasefire in Gaza, invoking the most powerful tool available to a Secretary General for the first time in 5 decades. Well, Guterres sent the letter under Article 99 of the UN Charter, which allows him to bring any issue seen as threatening international peace to the Security Council's attention. And the UK immigration minister has quit just hours after the government's new asylum seeker deportation plan was published. Well, Robert Jenrick's departure comes after the legal changes which aim to ensure ministers can finally proceed with their controversial Rwandan deportation program. And former UN Ambassador Nikki Haley has solidified her claim to be the main alternative to Donald Trump for the Republican nomination. With the polls shifting in her favor, the fourth GOP debate saw Haley drawing attacks from her rivals over her connections to Wall Street donors and hawkish foreign policy views. Coming up, the UK government promises it's still committed to net zero at COP28. But did they convince anyone after their recent watering down of Britain's green agenda? Our deep dive on the Pulse is next, and this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Well, good morning and welcome to Bloomberg UK, everyone. A special focus on the biggest challenges facing the British government, economy, financial services, and markets. I'm Francine Lacroix. Now, with the UN climate conference taking place in Dubai, the UK government is trying to prove that it's still committed to net zero. That's after watering down Britain's green agenda just a few months ago. The Prime Minister, Rishi Sunak, has pledged to spend £1.6 billion on climate projects. Now, the UK will also spend £500 million to tackle deforestation and about £300 million for energy innovation projects. Now, it will also contribute up to £40 million for the Key Loss and Damage Fund to help vulnerable countries cope with the impact of rising temperatures. Now, Britain has long tried to present itself as a global leader in the shift to renewable energy from fossil fuels. But in September, Sunak scaled back a series of green commitments, arguing it's unfair on British taxpayers to do more until other countries have caught up. Then in June, the UK's Independent Climate Change Committee said that Britain's chances of achieving its goals are getting slimmer. And just yesterday, a new report by the National Audit Office said the UK government lacks, quote, an effective strategy to make the country resilient to extreme weather events that can cause significant disruption. Now, the Prime Minister, though, has defended his government's green ambition at COP28.
Our 2030 target means the deepest cuts of any major emitter, and we're determined to deliver. But instead of putting more pressure on working people, we're choosing a pragmatic new approach. We're ramping up renewables and embracing the opportunities of technology and green industry, because we've shown that you can cut emissions while growing the economy and creating jobs.
Lots to discuss with John Fryer, Bloomberg's senior executive editor for business, finance, and climate, and also Alistair Marsh, who covers ESG and climate finance for Bloomberg. Both of them, of course, were on the ground at COP28. So thank you for joining us. John, first of all, where is the UK in all of this? You know, some investors say, look, they're scaling back, but actually in certain projects, they're still quite ambitious.
Yes, I think there are criticisms, obviously, of this government for scaling back a lot of its green commitments. But when you take it sort of in the round and you look at how far the UK has come in the last 10, 15 years on things like wind, the UK still is very much sort of in the vanguard of a lot of this stuff. And also important, to point out there is a little bit of a gap between the rhetoric of this government, which is trying to protect, trying to sort of show that it's skeptical on net zero. But when you look on the ground at things like regulations on electric cars, they're still actually doing quite a lot.
And Alistair, you follow the money, right? You try and make sure that we talk about where the money and where capital is being deployed. Again, what does the UK have to offer? Is it new technology? Is it actually getting investments and projects being built here?
Well, the biggest attraction, I guess, is the City of London, the financial heart. And Rishi Sunak, when he was the Chancellor, talked about making the City of London the first net zero financial centre, and the UK is still trying to position itself as the place to be for financing green solutions, green technology. And actually one of the big things that Sunak announced at COP, or that he was keen to talk about, was the Masdar and RWE financing of the Dogger Bank wind farm. And, so positioning London to be a place that can channel the trillions, or the billions at least, towards these renewable solutions.
The concern, John, is that actually it's difficult to position yourself as a champion of green bonds, green, finance, if at the same time you say actually the ultra-low emission zone is maybe something that London doesn't want. Like, how do investors look at the two?
Yeah, I think you're seeing this playing out in a lot of different countries around the world, right? We're seeing the same thing in the US. So we have the Inflation Reduction Act, which is, people say will revolutionize American industry, but at the same time you have a lot of politicians expressing, especially in the Republican Party, expressing skepticism about that. You say, no, push it back. You also have the same thing here. Lots of mixed messages, and I think you're right. That is the challenge for investors, to figure out which is my North Star. Are we actually going to go all in on renewables, or is there going to be a slowdown? And that, I think, is why things like the COP matters. We're going to see the statement in a week's time about consensus where the world is on renewables versus fossil fuels. And that's what it's interesting. Words do matter.
Yeah, and of course, John, you and I were covering COP28, and the big focus is actually whether there's a phase out or there's word of a phase out of fossil fuel in the communique. And I think Rishi Sunak was one of the leaders pushing for that.
Yes, I mean, I think this is where we are now in the COP negotiations, right? So we've had the first 5-6 days. There were a lot of announcements. There were a lot of fireworks. Some very significant things announced, obviously loss and damage. Some skepticism about some of the other things that were announced. But I think now the real question is how far can negotiators go on this question of phase down, phasing out of fossil fuels. The Saudis in an interview with Bloomberg told us 2 days ago they would totally not accept any of that. John Kerry, on the other hand, obviously pushing for that very, very, very aggressively. And this is now where the hard yards are now. The next 8 days, 9 days, we're going to see a lot of hard-fought negotiations in Dubai over this language.
Alistair, how do you see all of this playing out? We're also in election year. The UK government has to call an election, or the Prime Minister has to call an election by January 2025. Is this going to be at the political forefront of these two battle lines?
I think so. Well, as John mentioned, the talk around ULEZ, that really exposed the fault line between trying to get to the bottom of what is it that the populists want. Are they really willing to sacrifice returns, cost of living to pursue the green agenda? Is that, I mean, maybe that's a binary choice, some would say, but that's certainly what the way this debate is forming. And I guess that the things that we were hearing at Dubai, certainly from the financial perspective, was that all of this green and renewable agenda, it needs to be thought about through the prism of regular finance, through profit and loss. Does this really stack up against the returns that we need? And in terms of pensioners and so on, it would be the same thing. Does this actually stack up, or is this going to cost me? And in the moment of high inflation, cost of living, that's the real question that will matter, I think.
Alistair, you've done some great reporting, and there's certainly one article that really caught my eye, which, you tried to break down what it really means for banks to put some of these trillions into ESG. Now, we did have the announcement of Altera, which is an UAE-backed fund, in COP28, but are you optimistic that actually enough money, there's real pledges from the finance community, from financial services, to put the money where it needs to go for the transition?
Well, what was really interesting to us this time versus, say, Glasgow, where you had the announcement of $130 trillion ready to finance the transition. This time around, there's much more pragmatism, there's much more realism, and the finance sector is saying that climate finance will have to follow the rules of regular finance, i.e. if the returns don't stack up, the money will not flow. And so Altera is very interesting because it's about trying to find new financial structures that will allow for financiers to make a return, but the money to go where it's really needed, i.e. the global south. And so the jury's out as to whether these kind of structures will actually work. But finance, the message from Wall Street, there was a lot of a big Wall Street presence there, was we will finance the transition only to the point that it makes sense returns-wise for us.
John, the problem is that because there's an absence of regulation, then it's really up to the banks or global finance to define, a project that's good, that's green, that's ESG friendly, or that's climate transition investment.
Yes, but also it's important. I mean, Alice is completely right that we are seeing a new era of pragmatism here from big finance. But it's also important to look at things like the World Bank. They are getting very, very heavily involved here, and part of their mission is to try to help make it worthwhile for financial, for commercial banks to lend to the global south. So they want to, this concessionary finance, put in the first money, the first tranche of money into projects, solar projects, wind projects, whatever you want to have in Africa, and that will then. That risk-free investment from the perspective of big banks will make it worth their while then to come in at an attractive interest rate.
But Alistair, when we talk about, of course, a return on investment for financial companies investing in green, I understand, but what's the benchmark? So if you invested £100 in one of the big oil majors, you'd be getting dividends, your share price would be up significantly. So what are we talking about to make these projects viable?
That's the very good question. I mean, if you look at green, green stocks, they're down like 20% this year. So it's a pretty ugly picture this year, and that's mostly driven by inflation. And that is really awkward when, as you say, big oil and the kind of energy majors are really outperforming. If you look at this on a pure kind of hard numbers basis at this point, yeah, you're going to get a better return out of the fossil fuel majors, and that's really not great for what we need to happen on the transition, the flow of money towards renewables and clean energy. So, yeah, it's a very tricky situation at the moment, and money talks. That's kind of the message that we got from Dubai.
John?
I agree with that, but also I think it's important. There is a long-term and short-term perspective here as well. In the short term, everything that Alistair said, is right. This is not a great time to be investing in renewables, especially when there's so much, when the returns on fossil fuels have been so much better over the last year and a half. But if you take a long-term view, prices are coming down. Solar and wind prices, we've seen that. And the big bet is that the next generation of technologies, batteries, carbon capture, will start becoming cost-effective. I mean, batteries, that curve is already coming down. Can we get carbon capture to be much cheaper than it is? And, the big prize here for a lot of investors, yes, in the short term, this is difficult. But if you said 15 years ago that Tesla would be the world's most valuable company, no one would have believed you. So in this space, I think that is still sort of the lure, that there is a lot of money to be made here if you get the timing right, but you have to be patient.
Yeah, at the same, I mean, we had John and I had a great time, actually, because after working like almost 18 hours a day, we also went to see OceanX and Ray Dalio. I mean, it's amazing to almost have seen all of global Wall Street show up. Right? I
mean, this was one of the most remarkable things, certainly about the first week of this COP. I mean, it was the closest I've ever seen a COP being to being like a Davos.
Yeah.
We didn't quite have the Jamie Dimons and the Solomons there, but it was pretty close. And I think there was a sense that, there was a lot of business to be done there, not just talking to prime ministers, etc., but other business on the side. So it was a very interesting COP. Yeah. Remains a very interesting COP from that perspective.
Yeah, interesting and intense. Thank you both, John Farrar there and Alistair Marsh. Now, coming up, we'll have plenty more, of course, on COP28. We'll also be joined by Jonathan Maxwell, a leading specialist investor, to look at the role that energy efficiency plays in the green transition. That's up next, and this is Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua. Now, my next guest is a leading investor in the energy transition. His company, Sustainable Development Capital, has now raised over $2.5 billion for investment in energy efficiency, making it one of the largest specialist investors of its kind in the world. He's also the author of The Edge, How Competition for Resources is Pushing the World and Its Climate to the Brink. Well, Jonathan Maxwell, founder and chief executive of SDCL, welcome to Bloomberg. And Jonathan, thank you for the book. I had a long flight, so I started reading it. And page 44, you have this amazing, really global greenhouse gas emission diagram. 18% is actually from agriculture. What do you think we should focus on to push ahead with the transition?
So thank you. The diagram shows that 80%, 80, is to do with energy and related matters. And as you say, about 18% of that is agriculture. What I love to talk about is how much energy is lost in making stuff. So take food. You lose about 70% of natural gas, which makes fertilizer, making fertilizer. 70% evaporates, and then huge amounts of energy gets lost, Francine, getting food from the farm to the fork. So the energy efficiency of food is less than 10%. The energy efficiency in the world is very bad. It's less than 30%. That means, though, all the energy we're talking about on COP28, we're investing in, it's even creating conflict. Most of it's getting lost somewhere in the journey from being extracted to used. So that's, for me, the biggest story in the energy sector.
So, Jonathan, and this, I guess, gets a little bit less headlines because it's less sexy than finding nuclear fusion or than the new technology that we're working on. Do you feel like COP28 so far, and we still have 10 days to go at COP, actually really put it on the map that if we're going to be more efficient, in terms of the technology that we use to save energy, it will make a material difference?
Yeah, I mean, I've been going to COPs since 2009. This is the first time ever that energy efficiency has made it onto the headlines. So there are actually two headlines. They are sit alongside each other in terms of calls that have been made for an outcome. One is tripling the rate of renewable energy, as John just discussed. But the second, it's never been on the agenda before at this level, at the top table, is doubling the rate of energy efficiency. And the reason it's there, and it's not too soon, is that that's the only way we're going to get to decarbonisation targets. And it's the only way we're going to be able to, by, say, 2030, get anywhere near the pathway required for decarbonisation. So I'm thrilled. This is a huge moment for the international energy community if we can focus on energy efficiency.
But, Jonathan, the problem with energy efficiency is that it's very capital intensive at the start. So if you're changing, infrastructure or retrofitting buildings, it costs a lot of money. Where does that money come from?
So I think the first point I'd make is the wonderful thing about energy savings, energy efficiency, is it saves money. So the savings that you generate by doing the same with less energy, or even more with less energy, pays for the projects. Now, the question is how long it takes. But these projects in current high energy prices in Europe and even in America only take 2, 3, 4, 5, 6 years to repay. That's very different from a long-term centralized energy plant where it may take decades to design, develop. The second point is there are investors like us. So I invest all the time in projects that deliver energy efficiency solutions. And instead of the upfront cost, investors like us will fund the project. A great example is in 2015, we changed all the light bulbs for Santander Bank, and they ended up paying us a fee which was less than they would have been paying business as usual. If we did this in the NHS in the UK, the NHS would save £1 billion over the next 10 years. It's a massive economic productivity play.
But again, where does that, so with all that has been agreed so far at COP28, which is low-hanging fruit, but still there wasn't the fighting from countries that we've seen in the past, are you confident that that pool of capital that's needed will come from institutions, whether multilateral development banks or whether private finance?
I think there's a massive role for private finance. I mean, we're a great example of that. Over the last couple of 5, 6 years, we've raised $2.5 billion to invest in these projects. We're backed by insurance companies, pension funds, We partner with government. We've actually just announced a partnership on Saturday with the Mayor of London to create a programme just to focus on London. But the private sector has a massive role to play here. There is a very large amount of dedicated institutional infrastructure capital like ours that can invest in these projects. And that is the biggest opportunity. Decarbonise public buildings, industry, data centres and commercial industrial facilities using private finance and work within a regulatory context which insists that companies and countries can't just go on wasting most of their energy.
The return on these investments, just because of the nature of it and also what we're seeing given geopolitics, will be lower than, I guess, the big oil and things like that. Do you see a will of people maybe still having a return on their money, slightly lower, but to invest for the transition?
I don't. If you don't mind me saying so, Francine, I would slightly contest that. I think that specifically with energy efficiency, because you're investing in something that saves money, the investor's winning and the counterparty who's paying less for their energy is winning. It's a massive marketplace. I would not say that the returns are less for the risk than any other form of energy generation. And in fact, if you think about the fact that 70% of the world's energy is used in buildings, industry and transport, what we're really talking about is that the energy sector needs to gear up to serve the customer. Almost all major energy companies sell energy to the grid into a centralized network. What I'm talking about is helping the 70% of the world's energy users that need reduced energy costs, better energy security, and decarbonisation. And that's what energy efficiency can do. It's the largest, fastest, cheapest and greenest source of clean energy, greenhouse gas emission reductions and energy security. I think and we have proven through our investments over the years that they can make more money, not less.
Jonathan, thank you so much for joining us today. Jonathan Maxwell, their founder and chief executive officer of Sustainable Development Capital, also the author of The Edge. It's an easy read, actually, and it's quite quick, so I suggest everyone maybe pick it up. Coming up, we look at the politics behind the Prime Minister, Rishi Sunak's climate messaging at home and abroad. More on that next, and this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Now we continue our deep dive into COP28, the UK, and of course the climate transition. We've been speaking about green investment and of course the macro challenges. Now let's turn to how it's playing out politically here in London. Well, Bloomberg's Ellen Milligan joins us with the very latest. Ellen, when you look at, I guess, election promises, or as both parties gear up towards the election, which has to be called for by January 2025, how does climate change, how does green financing come into this?
Well, you saw 2 months ago Rishi Sunak try to create a dividing line with the Labour Party when he watered down a number of green climate goals, for example, the date in which the UK begins to phase out the new sale of gas and diesel cars. He tried to create a political dividing line also with the Labour Party by unveiling a number of new licences, oil and gas licences, to compare themselves to the Labour Party, who says that they won't issue any new oil and gas licences. So 2 months ago, climate and green issues were very much being used as a political football a year out from a general election by Rishi Sunak's administration. And obviously, in this last week, you've seen Rishi Sunak try to simultaneously marry up his messaging for a domestic audience with that for an international audience at COP28, where you didn't hear the same rhetoric. You actually saw him be a lot more positive about tackling climate change, a lot more persuasive of the arguments about needing to get to 1.5 degrees and pushing other countries like China, for example, to follow the UK's lead in that.
And Ellen, at the same time, so we were at COP28, and it was incredible to see a lot, I mean, not incredible given the polls, but certainly Sir Keir Starmer got a lot of attention at COP. So do we know what Labour stands for?
It's true. Keir Starmer spent 3 days at COP. Rishi Sunak, who I was with for the day, spent about 10 to 12 hours there. So there was a difference in terms of the presence there. But Keir Starmer's been quite clear. He has put the green agenda right as a top priority, and he also sees it as a big growth opportunity. The issue for Labour is this 28 billion that they continue to water down that they will spend on green energy.
Ellen, thank you so much. Ellen Milligan. And also a reminder of Leaders with LACWA Goes Green, the latest episode with Jennifer Holmgren.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck.
Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Rate hike bets ramping up for the BOJ. Governor Ueda's policy chat with the Prime Minister Kishida fuels rapid sell-off in Japanese bonds. Oil bounces back after nearing a 5-month low on signs that global supplies are exceeding demand despite OPEC's plan to rein in the production. And a tender offer at SpaceX is said to boost the value of Elon Musk's private company to $175 billion or higher. More on the Bloomberg Scoop. A very good morning to you. Governor Ueda wants to out-Trump Kuroda. And from the equity perspective, Danny will take you through the bond perspective in a moment. You have this. It is a blood red sky on the Nikkei, down 1.76%. It's hardly what you call a horrific performance, but it's the standout block in green that you really want to look at. Those are the financials, and they are up. Financials are the potential winner of any exit from NI or P. Rest in peace. Negative interest rate policy. Will they? Will they go in December? Is that too soon? When will they blow off yield curve control? Whatever the debate is, you must ask your questions about global liquidity. Equities are priced to perfection. You know that. The elixir of life was the drop in those bond yields, the rally, the rate cuts. But the market has been lampooned this morning by the possibility the Bank of Japan at the December meeting may shift. No horrific impact on U.S. equities at the moment, but the collapse in oil and rates, that pivot from $100 oil, 6% rates, deflation, and rate cuts, 5 days of losses has not helped the oil stocks in Europe this morning. David Costin over at Goldman Sachs talks about the macro backdrop, talking about it as being much of an optimistic scenario is already priced in to some of these equity markets, especially in the U.S. Asia down by 1/8% this morning, Danny. So that's the state of play. Let's see just how much of an Ueda shock and will he out-Trump Kuroda from last Christmas. Good morning.
Good morning, Manus. Well, here's the thing to keep in mind. What Ueda said in talking to government officials that policy is going to get tougher at the end of the year may have shaped the narrative in terms of expecting this decision to be a live one. But the driver of the bond market jump itself is something our American audience will be really familiar with. That is a government bond auction. The initial leg higher in JGBs was a very poorly received 30-year bond auction in Japan. We moved 10.5 basis points higher. That does is the biggest jump since last year, since the shock of widening the band of trading. So that's the move in JGBs. The yen also moves more than 1.5%. It's now at its strongest level in about 3 months. Markets say 45% odds that by the end of this year, the Bank of Japan will be done with negative interest rate policy. It's having a repercussion across global bond markets. 10-year yields, those start to fall. We're looking at it. I mean, the price itself starts to fall. The yields moving higher by 4 basis points. JP Morgan calls it silly season for bond market liquidity. Finally, Brent crude, a huge move in commodities yesterday. A lot of it being blamed on the algos, but we did see the Bloomberg Commodity Index fall to its lowest since 2021. Oil, for its part, had fallen near a multi-month low. We're rebounding today, but again, how much of this is just based on things like supply, those kind of fundamental issues versus just the algos going at it? I mean, it's to backtrack a little bit to the Bank of Japan, because you know I love a pun, you know I love a metaphor, especially when it's just absolutely tortured to, I mean, especially when they just torture it to try to make it Christmassy. So we got to go to this. This is from Calvin Yeo of Merlin Fund Blue Edge Advisors, who says, while everyone is watching Santa Claus loading the bond tree with presents, the BOJ Grinch just snuck down the chimney with coal in hand for the 2nd year in a row. How's that for a metaphor, Manus?
That's beautiful. I mean, you couldn't wait to get on the phone this morning with that. You're going, I found this one. I think this is the one that I want to use. And you're right, it is the Grinch. It is the Grinch if it comes to pass that next week is a live meeting. The issue that I have, and I've been on IB this morning with a number of brokers and a number of traders, is saying, look, the Bank of Japan is playing chicken with the exit process. If it does, it's going to exit NIRP first, and the move will be glacial. Well, let's put some of those thoughts to our guest. It's Yusuke Miyari. He is the FX strategist at Nomura. Good to have you with us this morning. So here we are. Ueda has essentially been the Grinch. He's come down the Christmas tree. He's raised the specter of a change in policy at the Bank of Japan. Do you think next week is live? And if it is live, what is the choreography? Do you think they are playing chicken with the exit, or will they dare to exit NIRP next week?
Thank you for inviting me. So, yes, I think the BOJ meeting, the importance of the BOJ December meeting has increased after the Ueda's speech at the Upper House today. So there was already a decent market expectation that the BOJ will normalize its policy in 2024, but there was no strong consensus that the BOJ could move in December 2023. And his remarks today, referring to the BOJ's work going to be challenging from this year and to next year, likely ignited the market expectation that the December meeting policy change could happen.
Yusuke, though, if I look at the setup, you have still Japan not with long-term inflation sustainably above 2%. The rest of the world is starting to experience a slowdown in inflation. Would it be a policy mistake if they moved now?
I don't think it's going to be a policy mistake. If you look at the Shunto wage negotiation result or spring pay rise negotiation result, there has been positive news from the labor union side as well as the Japanese company side. So we are starting seeing a virtuous cycle of wage growth and inflation in Japan. So raising by negative policy rate by 10 basis points, I think that's not a policy mistake, even at this situation.
Well, here's the issue, isn't it, what we need to debate, which is if they move, will it be, as different people have said to me, it's going to be incremental, it's going to be glacial. If they go from negative 0.1 to plus 0.1, you're hardly unseating every carry trade in the world out there. The yen will still be the carry trade of choice. So let's talk about the scale of change and the pace of change, because that is perhaps a little bit more material to the market. Would you agree?
Yes, I think from the BOJ speak so far, I think the policy rate hikes could be incremental, and I think the BOJ is going to be patient, cautious about raising its policy rate. But in terms of the currency, I think we need to see the U.S. side or the euro area side, the U.K. side to talk about it. If the Fed, ECB, BOE starts to cut rates policy in 2024, but BOJ raises policy rate, then that kind of a narrowing the rate differential will smallen the negative carry cost. So from the currency perspective view, we need to talk about not just the BOJ, but from the overseas central banks as well.
I mean, what could we see? So we're looking at just below 145 on dollar yen, the lowest since September. What could this get to when we actually do see that action being taken?
So if we have a combination of the BOJ raising its policy rate and also the majors of cutting, and we could see dollar yen declining to 140 by middle of this year and 135 through the end of 2024. But at the same time, we should bear in mind that the market is expecting the BOJ's negative interest policy exit a bit too much, I would say. So the governor retained his comments that the BOJ is not yet in a full mode to talk about the exit policy. He just hinted at the exit policy, right? So there could be a December meeting could be just a guidance towards ending negative interest policy or YCC and not a hawkish policy change that we expect right now.
Yeah, he said we are not at a stage where we can talk about an exit now, but we will ensure it will go smoothly when it happens. You should ask Ben Bernanke about that on how to exit things smoothly. We all need to go back and look at a few charts from, I think it was 2013. Now, I'm drawn to your perspective, which is the scrapping of NIRP is more proactive normalization step than yield curve control tweak. So with that in mind, am I going to get a much more aggressive move in dollar yen relative to the rise in yields on 2s and 5s? I mean, we haven't spoken about yields yet in terms of where you think they could go to. So the theater of NIRP, another tweak in YCC, what does that do to the curve? What does that do to 2s and 5s in Japan?
Yes, I think the revision, when the BOJ revised the YCC in July and October, BOJ continued to say that it will continue its easing policies still persistently, whereas if the BOJ starts to raise its short-term policy, that means it's a rate hike and policy tightening. So I think the short end will eventually rise and the curve will flatten in that case.
You know, I can't help but wonder, in terms of making sure that this runs smoothly, that this functions okay when they do start to exit policy, if they do tweak YCC, are they under a bit of a time crunch to get some of that done before the other majors start to cut? Does that timing matter for the BOJ?
I think it matters. So when the overseas central bank starts to cut, that is a signal that the overseas economic growth is starting to slow, right? So in that case, the BOJ may refrain to raise its policy rate aggressively. So it's better for the BOJ to move earlier rather than later.
Does that mean it needs to happen like in January? Does it need to happen really soon? Because the market thinks cuts could come as soon as April for the ECB.
January is a possible meeting because the BOJ will publish its economic projection. And recalling when the BOJ revised its YCC in July and October, that was when the economic projection was released. So January, April, those kind of quarterly meetings are important.
Yusuke, from a global perspective then, Danny and I are going to talk more about liquidity later. There's a great use of the Fed's window for liquidity. So we're gearing up for something strange in markets. To what extent will a significant U-turn by the Bank of Japan suck liquidity away from U.S. bond markets, global markets, that repatriation sort of philosophy that's espoused by some people? A, do you agree with that? And B, will it happen?
Yes, on the repatriation, we've been looking closely in weekly Ministry of Finance data, but there hasn't been any sort of large repatriation so far at this point. So if you compare the overseas bond yields and domestic bond yields, the overseas bond yields are still high, and that level of the bond yield is still attractive for Japanese bond investors. So at this point, even if the BOJ raises short-term policy, if it's like a not significant one, if it's an incremental one, cautious one, then we think the repatriation won't be that large to absorb large liquidity from the global market.
All right, Yusuke, that's all we have time for. An exciting meeting potentially to come in a few weeks' time. That's Yusuke Miyayuri of Nomura. Thank you so much for joining. All right, Manus, let's get to some of the other top stories that we are tracking on the terminal this morning. President Joe Biden has accused Republicans of playing chicken with U.S. national security after the Senate blocked $66 billion in emergency Ukraine aid. It's fueled fresh concerns over Washington's commitment to support Kyiv's fight against Russia.
The European Union is nearing a deal on what it's set to be the most comprehensive regulation of artificial intelligence in the Western world. Negotiations have already agreed a set of controls for generative AI tools such as ChatGPT.
Woodside Energy Group is in preliminary talks with Santos on a potential merger. It opens the door for the creation of an Australian gas export powerhouse amid a global wave of multi-billion-dollar energy deals. Manus.
Well, coming up in this hour, we speak to Jim Caron of Morgan Stanley Investment Management.
And oil is hovering around a 5-month low on signs that global supply are eclipsing demand despite plans by OPEC+. Manus, we're going to discuss that next here on Bloomberg Brief.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, oil has fallen. It's rebounding today, but yesterday it fell to the lowest since June. There are signs that global supply are eclipsing demand concerns, despite OPEC Plus planning to rein in production into next year. Joining us now is Bloomberg's oil trading reporter, Alex Longley. Alex, I have seen some commentary that it's the algos that are behind this. It's the momentum traders. How are you distinguishing what's a fundamental drop in the price of oil versus something more technical?
And clearly those two things are even trickier to discern when we get into December and year-end position squaring too. I think the truth is both. Clearly Brent had a break lower yesterday beyond the lows from earlier this quarter. That's got momentum guys going on top, which means we've seen this additional selling from the algos, as my colleagues in the US have written about quite extensively this week in our big take as well. But the fundamental case for the reason crude has moved lower is a supply story. It's high exports out of the US, it's higher production in countries like Brazil and Guyana, and even in pockets of the North Sea. Norway's giant Johan Sverdrup field has been pumping at pretty strong levels. North Sea loadings in December were at a multi-month high. So there's all these small pockets that collectively are adding up to a pretty hefty chunk of supply. And most significantly, it's in the US. Now, we didn't see it in the US data yesterday because of the sort of peculiarities of US data. They had lower exports, but an extremely high uncertainty factor in that data. But if you talk to traders and analysts, the feeling is that this week and next, we're seeing exceptionally high and probably record US crude exports.
And look, that non-OPEC supply is also going to be very much weighing on the group. The SPR is being refilled in the United States of America as we speak. What do you make of the calls? I looked at Citi this morning. I was quite surprised. They said that there is a risk that given this market context, you could have an emergency OPEC meeting. Now, we hear these kites flown all the time. I thought Prince Abdulaziz bin Salman's point with Will Kennedy was very clear, which was, we're prepared to do more, we're prepared to extend. Can you see an emergency meeting? I mean, where do you think the risk of that is?
It's a fine balance to tread, right? Because if you, in a matter of days after we've just had a meeting, go and have another meeting, you're in danger of looking panicked rather than confident, aren't you? So I think it's tricky to say whether there'll be a meeting before the end of the year. I think what is clear and what we've heard this week is that they are steadfastly making sure that they will balance the market and do what they need to do to balance the market in the early part of next year. I think in this period we're in now, we're in kind of a middle ground between the aftermath of the meeting and some of the sort of follow-up posturing that we're seeing after the meeting. Remember, these are cuts for January. Some of those barrels are trading now, but it's a policy that's only just been made. And it wouldn't surprise me if given a few weeks of lag, given us getting out of this kind of December position squaring malaise, algos we've talked about already as well, and we get into the new
Danny
year.
loves those algos, Alex. Don't be too hard on the algos.
They're my only friends.
Danny quashes me every time I sort of go, oh, it could be the algos. She goes, oh, there's real money in algos.
He called them not real money yesterday. They certainly have money. They're not playing with monopoly money.
She's off.
Alex, look. It's not even Friday, and I'm done. No, but Alex, okay, so I know you're an oil trader reporter, so please forgive me for this, but I look at something like sugar yesterday, which also absolutely collapsed. Again, I realize this is not the market you cover, but that's just to say that it is the overall commodity sphere which had a very bad day. Does that not tell us that potentially there is something with demand? If it's not just the oil supply question, it's like the entirety of the commodity sector is experiencing these ruptures.
I think it depends. There's certainly a broad-based economic argument for the commodity space, right? But in turn, each of those commodities have their own idiosyncrasies. I mean, as you know, I cover oil. On the oil side, it's a high supply story. But one thing across the commodity space that is worth keeping in mind at this time of year as well is every year the commodity indexes rebalance. And come the first week of January, and people will start to position for those moves now, you see this huge shift across commodity positioning as the Bloomberg Commodity Index and the S&P GSCI Commodity Index readdress where they're mispositioned versus the year before. And that often leads to huge flows in commodities like sugar and WTI, but across the board as we try and balance that mix. So I think at this time of year in particular, what you can also get is a lot of kind of cross signals where you may appear to have a commodity narrative, but what you actually have is, for example, a commodity index rebalancing or an idiosyncratic kind of this time of the year type of flow. So I think particularly in December, I'd be wary about drawing broad-based conclusions about commodities in the global economy.
I love that, Manis, that Alex is saying this in general, but it's clearly directed at me. He's basically saying, Danny, stop making connections where they don't exist.
So long as we don't sort of start saying, I wonder, will Jeff Curry come out with a full bull note, $100 oil again, come the January sales. Yeah, I mean, how we pivoted from that. $100 oil, that's toast at the moment. Alex, thank you very much. Alex Longley. There on the very latest in the oil market. Danny, just let's check in on these Japanese assets because things are moving. You've got dollar yen at the lowest level. You know, you're breaking through 140. We've just had Nomura on the show there. They're talking about 140 by the middle of next year. So we're not too far from that. At 135 is eminently possible by the end of the year. You've got Japanese government bond yields rising, Danny, the most in a year. And all of this is on the prospect that the December meeting could be live where the governor, Ueda, will indeed perhaps set the table for some structural changes in negative rates and YCC, but they won't do it all at once. The move will be glacial, according to the markets I've spoken to. Good morning from New York and London.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We're so excited about, first, the opportunity in AI is just absolutely exploding. And then we're talking today about the launch of our MI300X, which is our, let's call it the leading edge data center AI accelerator. And so we now believe the total market for this, it's upwards of $400 billion in 2027. It's huge.
That's the AMD CEO, Lisa Su, speaking to Bloomberg TV's Ed Ludlow at the semiconductor giant debuts that AI chip to rival NVIDIA. Or just those two letters and anything. I mean, the size of that market, $400 billion. And the whole chip market was sort of rallying yesterday on the back of the Foxconn guidance as well.
Yeah, I mean, there's a lot of excitement about that, a lot of excitement about something that should rival NVIDIA. Manus, you know what else there's a lot of excitement about? SpaceX. It's going to the moon. Do you have the numbers on these valuations? I mean, they're offering up some shares for private buyers. I mean, the numbers here are crazy.
Well, just think back to the summertime. What was it? SpaceX was valued, what, $150 billion. It looks like this is going to put SpaceX at $175 billion. That's according to people familiar with the matter. Can you imagine trying to get your hands on this stock? I remember I was in Dubai a couple of years ago, and there was this furious rally around the DIFC to try and get equity holders to get a hold of it. But what does that do? Where does that put SpaceX, Danny?
Well, okay, look, if this were to be a public company, I feel like that cheering is for me almost. I'm flattered, but I know it's for that rocket.
That's for the bots.
Okay, so if this is a great backdrop for this conversation. So as we envision SpaceX going to the moon in terms of valuation, if it were to be public, it'd be in the top 50 biggest companies in the S&P 500. Manus, that would make it more valuable than Intel, Disney, and Wells Fargo.
I know you like that one. We had a couple of different stats on that, but it's all about revenue and EBITDA and how. Well, of course, you've got the Elon Musk genius level of valuation, or as we saw with Twitter, perhaps it has another impact. Likewise with Tesla. Yeah. Do you trade Elon vicariously? But what, $9 billion in revenues from rocket launches and the Starlink business this year? We reported that last month.
Yeah. But this is the thing. I mean, you can just leave Twitter if you want, but if you got to launch a rocket, I mean, SpaceX is one of the few options. So Elon Musk or not, it's SpaceX.
we've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Rate hike bets ramping up for the BOJ. Governor Ueda's policy chat with Prime Minister Kishida fuels a rapid sell-off in Japanese bonds. Oil bounces back after nearing a 5-month low on signs that global supplies are exceeding demand, despite OPEC's plans to rein in its production. And a tender offer at SpaceX is said to boost the value of Elon Musk's private company to $175 billion or higher. We just had that discussion on the rocket going to the moon, but are yields in this Japanese bond market going to the moon too? So we had an auction. Yes, we had that talk from Ueda saying that policy action is going to get tougher at the end of the year. The market says, okay, maybe December is live. But what really gets us going is a poor 30-year auction for Japanese bonds. That's this right here. We jump 10.5 basis points in your 10-year JGB. That is the biggest move since last year when Kuroda widened the band of YCC and really shocked these markets. Are we in for something akin to that? Maybe an exit of negative policy for this meeting to come. Yen, that also is strengthening versus the dollar. We're just below 145. That's going to be its strongest level versus the dollar since September. There's ramifications across this global bond market. We're going to talk with Jim Karen over at Morgan Stanley about that shortly. Yields are higher by 4 basis points for your 10-year yield. Then finally, we had been rallying yesterday, and that was really off the back of weakness in this oil market and the commodity market, Manus. Commodities fell. The Bloomberg Commodity Index fell to its weakest since 2021. Oil hit a multi-month low, but we're up again 1.33% because, Manus, you know, it's my beloved algos. They're beating up this market as we're in December, the silly season for market liquidity.
Yeah, I'm never going to have a go at the algos ever again. But of course, if the Bank of Japan pivots into this exiting NIORP and at the same time tweaks yield curve control as the other central banks are in cutting mode, what does that do? Does that put a floor on the dollar yen? When it comes to the equity story, Danny, there was a very immediate reaction. It was a blood red sky all the way across the Nikkei. Down 1.7%, but I take your attention to the slice of pie that is green, and those are, of course, the financials along with utilities, slightly more defensive. But the financials and the insurers were the two beneficiaries on the equity side. If December is live. And by the way, the people I've been speaking to over the past sort of 4 or 5 hours have been saying that if the Bank of Japan does exit NIRP, it will be glacial. It'll be from -0.1 to +0.1. That is not going to destroy the carry trade. Equities are a bit lighter on their feet this morning. We're down. David Costin at Goldman says much of the optimistic scenario is already reflected in the US. Stocks are vulnerable to any macro shock. Is the Bank of Japan moving off NIRP apart macro shock? Stocks in Europe are lower this morning. dragged lower by the airlines. You've got a downgrade going through on a number of the airlines this morning. Air France leads the drop. JP Morgan has shifted their stance. So you're looking at a whole host of the airlines under pressure, Air France being the main laggard there. And Asian stocks are down by 1/8%. Danny, good morning. Will Ueda out-trump Kuroda? Good morning.
Good morning. I mean, we've gotten a lot of action in this currency market right now, and we're just talking to Nomura, who said 140 by mid-2024 when it comes to the yen. But Manus, we have some lines dropping now. The euro is now the franc is now the strongest versus the euro since 2015. This is fascinating because again, we're getting ruptures throughout this currency market. Is it off the back of Japan? Is it a liquidity issue? At the moment, we are looking, Manus, at a yen that is its strongest versus the dollar since September.
Yeah, and the debate is going to be this: is how much further can the yen accelerate if, as you say, as we said, the ECB is set to cut 150 basis points next year. What's that going to do to euro yen? The Fed are, in theory, cutting between 125 and 130 basis points. So that is going to be one of the interesting ones. But of course, Swiss is on the move. Set the table, Danny.
Yeah, it is. Well, I can't set the table, Manus. I'm not smart enough to do that, but I'm going to bring in someone who's a literal rocket scientist, but now works for Morgan Stanley. It's Jim Caron, Portfolio Solutions CIO at Morgan Stanley Investment Management. I wasn't not going to mention your rocket science background, Jim, once you told us that. Look, okay, it's a morning that started with the BOJ, with a bond auction, with what Ueda said, but now it feels like this is a market that is very tense, and it's global moves, be it Swissy, be it the American bond market. Does this tell you that it is a fragile market at this moment?
So let me throw one more log on the fire, which is that
Please.
We just came off of a month end, November into December, that was also a little bit pressured on the SOFR markets, which is the overnight financing rates. So look, December always comes with a heightened level of sensitivity to financing markets because it's a quarter end and it's a year end. It's what we call the turn. And essentially, whenever you start to talk about interest rates, BOJ rates, Fed policy rates, but the BOJ has a pretty big role here to play because they've kept their rates so low for so long that even though it might be a small move, even though this has been anticipated maybe in March, maybe not in December, the point is that if you have to start to worry about this could create other financing and funding problems. Now, whether that happens or not, I don't think it does. I think the liquidity is going to be okay, but we could get a shock, and I think that's what the market's building in, is that additional risk premium.
Jim, good morning. Good to see you. When we talk about shocks, we're trying to debate the scale of shift from the Bank of Japan. So I'm going to ask you the same question we asked to the first guest. The people I've spoken to this morning say it's going to be glacial, incremental, and not a shock. They're not going to unseat global markets and liquidity. But when the Bank of Japan goes, and they've got form on this, they don't go in small token moves often. They have done recently. Is it going to impact liquidity? Is there going to be any material shift in liquidity when the Bank of Japan blows off YCC and we have to reconsider our carry trades?
Look, I think liquidity is in a good place right now, but it doesn't mean that people aren't going to worry about it. And it's always about unintended consequences, right? So yes, people have used the Japanese yen and the Japanese government bond market as a collateral source and as a lending source. So what happens if all of a sudden rates start to go up, bond prices start to go down, and people need to post more collateral for the same loans that they've had? We already have liquidity stresses, leverage stresses, because interest rates are so high in other parts of the world. Could this add to something? The answer is, quite frankly, we don't know. But it does up the ante on the risk.
What do you make, though, of, I know you say there's not a problem in liquidity, but what do you make of the BOE flagging basis point trade in this huge short position in the bond market, in the American bond market as a risk? I mean, you'd hope maybe that would come from the Fed and not the BOE, but nonetheless, that's where we are.
Look, the dollar, global liquidity is an important thing. And like I said, like the SOFR rates started to spike up a little bit, and it's very, very topical right now. So any fixed income analyst, anybody in the fixed income markets is extraordinarily worried about this right now because yes, it's a small move. The problem is does it become a bigger move? Every big move starts out as a small move and then turns into something else. We're not going to know if we're through this until later this month. And, as other people have said, markets have, increased in price quite a bit, especially the risky markets, credit spreads, equity markets. Could that unseat things? It certainly could. And that's the risk.
I mean, you actually say you're putting forward the boring market for 2024. it doesn't sound as if 2024 is going to be boring. I mean, we're stacking up a few issues here. So, I mean, 64, I also was drawn to one of the lines in your notes, which is 60-40 portfolios had a good run, and it has. It's had a blinding run in November. So as you go into 2024, your role is to ensure what? That we drum along with 60-40, or do you diversify in a slightly more dynamic way?
I think it's pretty clear. You have to diversify in a more dynamic way. And part of the reason for that is that the interest rate cycle has changed, right? We can't rely on bonds to be the reliable hedge that they were against equities. And the fact of the matter is that we've had this decline in interest rates for 40 years, from 1981 to 2021. And that right now, rates may move more sideways. So when people want to buy long duration to hedge their equity portfolios, particularly if you think we're going to have a slowdown or a recession, that might not be the best hedge. So look, I think 2024 will be a very interesting year. I think it'll be very dynamic. And in order for us to maintain a level of balance in portfolios, I think that investors have to be dynamic alongside that.
Okay, Jim, thank you very much. We've got to be on our toes, dancing around these markets and aware of shocks. That's Jim Caron, Morgan Stanley Investment Management, our guest this morning. So here's one for you, Danny. I sat down. I had a bit of a day out on Monday. It wasn't buying a Birkin bag for yourself. It was with Charles Stewart. But if you want to understand, there you go. That's me getting out of the Wolf of Wall Street Lamborghini. It's a very ungraceful move. There we go. Oh, look at the pain in the back. Yeah.
Yep.
Not very sophisticated.
That's the dancing around we need in markets next year, man.
Exactly. Well, we're going to catch up with Charles Stewart very shortly on what he makes of the art market. They've just come off a blinding luxury week. The billion-dollar art and luxury man. Charles Stewart next on Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. So we've introduced some eye-catching auction items in our show over the years. And record-setting Ferrari, Lionel Messi's World Cup shirts, and the man behind it all is the Sotheby's CEO, Charles Stewart. And I caught up with him, Danny, at their New York headquarters. Let's take a listen.
Year to date, all in, I think will be closer to more like $8 billion overall.
I mean, you had a Picasso in there at $139 million, which sort of caught the headlines. It's the second highest ever on auction. Is the art market robust and strong, or how would you define it at the moment as you close 23?
Yeah, I definitely think the market has changed this year, and the art market's certainly not immune to all of the geopolitical market factors, higher cost of money that we're seeing in the world, the same factors that are influencing markets, globally. At the same time, what we have seen is there's strong demand for artwork that is A+ in quality, has exceptional provenance, and is fresh to market.
Is there any sign around the world of a slowdown? Are the Chinese slowing down? Are the Asian buyers slowing down relative to, let's say, the Middle East and Americas? How would you describe the landscape?
We definitely are seeing some changes in where the buying and selling demand is coming from. And I certainly would agree that, that Asia and China in particular seems somewhat softer than it was. That doesn't mean that it's fallen off a cliff, anything like that. We had very successful sales in Hong Kong in October and, have big plans for what we can do next year. We're opening a big gallery in Hong Kong in the middle of next year, which we're excited about. At the same time, we're seeing particular strength in the United States. I definitely think the U.S. is powering, a lot of the market right now, along with parts of the Middle East.
And I want to talk about the future of Sotheby's. The owner, Patrick Drahi, said, everything is open. It's just a question of offer and demand. Now, those are the words of Patrick. Is he exploring a sale of Sotheby's?
No, he's not. Patrick is incredibly committed to Sotheby's. I think he loves it as a business.
Is that a hard no?
I mean, no one can predict the future, but I would find it very, very unlikely. It's not in his plans or interests at all.
Now, you've got form in the IPO business, let's be frank. You took Altus to the market.
Yeah.
So it naturally lies. Are you pushing him to IPO? Is this the moment of where you've got great numbers, you're having a great run, come on, is this the moment to go for the IPO?
I think for a lot of companies, an IPO is kind of a culmination of a growth journey and something that they're really looking forward to. It's not the case at Sotheby's. Sotheby's has been a public company, within Patrick Drahi's broader, organization. There have been companies that have gone public, have gone private. So I would describe it as much more situational. It's not in our plans right now. We are really enjoying operating as a fully private company that suits us well and keeps us focused on our actual mission, but never say never. And I think, the point of raising capital to fund growth is something that we'll always consider.
Well, then let me just turn it around. Do you need capital? Do you need capital to grow the business?
No, we don't need capital to do what we're currently doing in our core business. And as you noted, we've been investing in real estate. We've made some acquisitions. We're expanding sales channels and categories and geographies. So all of that we can do within our core business. If we were going to be in a place where we were expanding Sotheby's dramatically beyond what we're doing, then yeah, there we might look at, if we wanted to make significant acquisitions, then that might be a different case. But it's not the moment we're in right now.
Well, that's Charles Stewart, of course, the CEO, Danny. And we were in a pretty amazing room. You walk in to Sotheby's in New York. It's over on the east side on the water. And you walk down the steps and you have the Wolf of Wall Street's Lamborghini, which they sort of let me sit in. As you saw, I very ungracefully got out of it. But I mean, it's just like a winter wonderland of just watches, jewels. The whole sort of hoard and treasure of Luxury Week is there. I'd encourage anybody to go and have a look at it.
I mean, man, it's okay. So you're like sitting in a room that's got Warhols in the background. You're getting out of Lamborghini Countachs. I saw your Twitter trying on, $1.5 million Patek Philippe. Manus, we get journalist salaries, right? You're aware of that, correct?
I did actually say. I mean, I'll put out the piece on watches a little bit later on. Shameless plug for my Instagram and Twitter. But I mean, the John Player Special watch is amazing. I mean, that's in the bandwidth. That's $300,000 to $600,000. That's your average banker.
Oh, affordable.
Your average banker can afford that, but I think then you said, no, just leave with the Patek Philippe. It was stunning. It's like $1.5 million. And we've got Lionel Messi's jersey, 6 jerseys as you come in through the door. So it's about memorabilia as well, isn't it?
Yeah. Well, Manus, I mean, get the Patek, because, you know, what do they say? You don't own a Patek. You just mind after it for the next generation. $1.5 million. It's an investment for the future.
There you go. There you go. I'm just one of those sort of like brand new sort of watches off the rack. Let's talk about luxury. And here's what Charles had to say about the future of America versus Argentina did come up. I mean, you are the billion-dollar man. You've just had the art sales. But when I look around this room, you've got Ferraris, you've got merchandise, you've got the Birkin bags out there. What's going to sing in this week's sales?
Well, I think the sell-through rates across all the categories will be very strong. Our jewelry and watch sales will be particularly strong. But if you look in terms of just high value, you've got the Lamborghini and some other cars, which are really exceptional. But you've also got the Lionel Messi jerseys from the 6 matches in the Qatar World Cup, which are sort of, you know, one of a kind.
I mean, that place erupted the evening that World Cup went through. I mean, he is a living legend. 6 jerseys. The bidding is open. What's it, $5 million at the moment?
It's a little over $5 million at the moment, but there's 10 days to go, so a lot of time still.
Do you think there's a lot of excitement around that? I mean, you look at Messi. Have you spoken to Beckham? Are you going to sign up Beckham next year?
You know, we'll see. We have sold a lot of very iconic jerseys and broken a lot of records in the process. We'll see if this breaks a record as well. But the rise of game-worn sports merchandise is absolutely a phenomenon. We've signed a deal with the NBA about 2 weeks ago to bring game-worn jerseys from NBA matches this year to market, and we've already had our first sale there. It was a huge success.
So I look at like Argentina versus America, because that's what goes through my mind. The Argentinian jerseys versus Jordan's NBA jersey. Who do you think's going to win, Charlie?
This is the magic of auctions. We'll see. We'll see.
So tell me what we've got here. This is, I mean, I'm not going to fit into that, am I?
No. We could try. I mean, actually, possibly. I don't know. But this is an amazing thing. I mean, you know, the history of sport and these game-worn, these race-worn suits. In this case, this is Lewis Hamilton's first Grand Prix suit from 2007, and it's part of our broader sports collectibles sale. Last week, or 2 weeks ago in Las Vegas, we sold his first Mercedes Formula One car from the 2013 season, where he raced 15 of the 19 races, the beginning of the Lewis Hamilton Mercedes dynasty, and that sold for nearly $19 million.
Manus, watching this, I just realized that I literally missed the biggest opportunity in my life. I have a signed Michael Jordan jersey. I literally have one of those. I, for one, think Americans will do better. I should have given it to you to sell to Sotheby's or get it sold at Sotheby's. I could be buying that Patek Philippe with that kind of money.
No, you could just be leaving me. You could be retired. If you put that up for auction, you get a few dollars, you're going to be gone. And we're not going to have that. It's amazing. I mean, the floor after floor within there, but the watches section is pretty amazing. I mean, on the Hamilton suit, I mean, it was a couple of weeks ago, his Formula One car from 2013, it went for $18 million, and I think they had a guide price of 10 to 15 million. Would you spend $1 million, $1.5 million on a Lamborghini that was in the Wolf of Wall Street?
I mean, like, I'd be scared to drive it. I mean, you saw what happened when they tried to drive it. Granted, I mean, they were on some things in that movie, which, you know, yeah, is so good. You'd be a part of history. If you got the money to spend, why not? Manus, speaking of money to spend, the euro is getting a whole heck of a lot cheaper. Let's bring this back to the market story. We are now looking at the strongest Swiss franc versus the euro since 2015. Remember 2015? That's when the S&P abandoned its currency cap almost 9 years ago. Man, it's a strange start to a month, to the silly season of liquidity with all these types of market moves. It feels like something's building here, or maybe it's just the usual December weirdsies.
Well, as we just heard from our last guest, which is, you know, it could be a bumpy ride going into next year, but the Swiss is on the move higher, the yen is on the move higher. Could the yen's move higher be blocked by the move from the other central banks? Or do you hide out in Swiss because of the European slowdown and the poor German numbers this morning? Danny, good morning.
Good morning, Manus. Well, before we can debate that, we have to get through the rest of the day. And we're going to do that coming up. We're going to have a look at some of the market-moving events for you to watch today.
let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
You're watching Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead in the next 24 hours. The European Commission and Council presidents are in China for the first in-person summit with Beijing's leadership in 4 years. Then at 8:30 a.m. Eastern, we're going to get weekly jobless claims out of the U.S. Will it add to the cooler data that's been adding to the bond market rally? Then after the bell, we're going to get earnings from Lululemon and Broadcom. We'll see how many people are buying up Lulus for the holiday season. Manus, maybe you want to buy a pair of Lululemon leggings. Maybe you want to buy some yen for your beloved for this Christmas.
See, I should have done the conversion and bought the Japanese, you know, the snow house before now. I should have sold that chalet in Chamonix and gone for the Japanese snow house. Yeah. Well, actually, that's not my trade, but that is. There are friends of mine who sit at dinner tables and actually talk about that trade, and I go, oh, "That's good for you." But the yen is on the move. The yen is definitely on the move.
Yeah, it is. Okay, let's check this out, because it's not just versus the dollar, it's versus the euro here, too. I think this is interesting, because if we're going to get 150 basis points of cuts from the ECB, is that the trade du jour to short the euro versus the yen, Manus?
Well, here's the thing. The yen, I'm just looking at Kit Duke's note. The yen has fallen by 25% in real terms since the start of 2020, and by the same amount against the dollar in nominal terms. So if we see this pivot from the Bank of Japan, the acceleration, the move, the capacity to really, really strengthen is ultimately going to be stymied by the Fed and the ECB and their moves. And I think that's the blocker to a monster mammoth yen rally.
Well, we were talking with Nomura early in the day, earlier in the morning, who basically said they need to get this done before the other central banks cut, or else it's a bit awkward for them. But he says, what, Manus, 140 by mid-2024?
Yep. And I think, as you and I have said in the past, it's about liquidity and the risk of a little bit of a spook in liquidity crunch. From Danny and I, and luxury from Sotheby's, we're on to Bloomberg Surveillance.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
There's still room for inflation to keep coming down without any need for really growth to slow.
Inflation's bounced around some, but if you take a step back, it's clearly on a glide path down.
Is this as good as it gets for inflation? For the moment, this is perfect.
If the Fed doesn't start cutting in March, I mean, I think we're going to have a harder landing.
Rate cuts in the first half are unlikely. We'll see what the second half brings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, Tokyo. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P just about unchanged. Let's go to something that isn't unchanged. Dollar yen, a break of 145 TK. Big moves in the Japanese yen.
There's macro, and for most of our listeners and viewers, this is macro. It's one big so what. And guess what? They're being overcome by events, the same events that we're going to see today with claims, what we're going to see tomorrow with jobs. The Japanese financial world, their economic world, is adjusting to what we've seen the last number of days of disinflation.
ECB, the calls out there, 150 basis points worth of cuts for next year for the Federal Reserve. If you listen to Deutsche Bank, maybe even 175. Then Bramo, you've got the BOJ. The BOJ seemingly overnight laying the groundwork to hike interest rates.
Yeah, the deputy governor coming out and basically said that actually if you abandon negative rate policies, that could be good for consumers because they're actually earning income, kind of the thing that we've been hearing about. And then for the kicker, you had Governor Ueda coming out and saying that it's becoming even more challenging from the year end heading into next year to continue with negative rates. The response is a plunge in the dollar versus the yen, an increase in yields in Japan. But this is the interesting thing. This was supposed to be the Armageddon moment for U.S. rates. Yields were supposed to go to the moon when this happened, or even signal that it happened. Not that big of a move.
Timing's everything. We're in a very different spot, TK, in December going into year end than maybe where we were a month or two ago.
Well, into the Fed meeting. I mean, it's going to be absolutely fascinating. Usually the December meeting is on the edge of snooze fest. People are packed up. Powell's beginning his shopping. He's always late. Yellen was way out front on the shopping before the December meeting. But the answer is, you go into the next meeting and the next. Amanda Lynham there in the opening talking about the certitude that we're not going to see rate moves until the second half of the year. Says who? I don't have a clue what the parlor game is right now.
I'll tell you the parlor game of the last 24 hours. Crude in the 60s. Lisa, the 10-year at about 4.1%. And all of a sudden, what does it mean?
Yes.
What does it mean?
Bad news maybe is bad news. And this is what a lot of people have been talking about. At the same time, there might be other reasons behind the oil amazing the narrative going forward.
Well, the narrative was last night. John Ferro out on Twitter last night with a nice setup, John, of the two narratives that are out there about slowdown or not. And I don't think we're any different this morning, and we won't be any different the first show of the year. I mean, you know, the first show February 1st, March 31st, sure. Bloomberg surveillance in April, it's going to be the same damn thing. We don't know what the narrative is between these two ideas.
Look, it's 2 months ago in reverse, Tom. I think I know what the Bears would say. I know what the Bulls would say. The Bears would tell you that we're pricing in economic weakness in our future. The Bulls will tell you, Lisa, lower rates, lower energy prices, that's going to re-accelerate growth, isn't it?
Eventually, once we get the landing that's supposed to happen, if you never have the landing, that's the problem, right? And I think that this is even Binky Chada's view of the world. We could get a recession. We need a recession. It just needs to be mild, and then we can get past it and move on. Can you price in a recession and then the aftermath of it before we even get it? And I think that that's one of the angsty moments for a lot of these bulls.
Let's start this morning with the scores. On the S&P 500, totally unchanged. On the S&P, futures going absolutely nowhere. Lisa's going to run you through some of the data you can expect going into payrolls tomorrow morning. Looking at the bond market, yields higher by 3 or 4 basis points, 4.14 on a 10-year. Let's call it 4.1%. And briefly, Lisa, erasing that move, but crude, $70.10 and into the 60s in the last 24 hours.
Hello, U.S. production. We can talk about that and how it might be offsetting a lot of the cuts elsewhere. Today is a drumbeat to tomorrow's non-farm jobs claim report. We're going to get challenger job cuts at 7:30 a.m. as well as U.S. initial jobless claims at 8:30 a.m. What I find interesting is continuing jobless claims that have continued to climb. Can we pay attention to this and get a sense that this softening is accelerating? There also is a focus on consumer financial health today. We get the third quarter household change in net worth. Remember last time we got a read on this, it surged to a record. We also get consumer credit at 3 p.m. This will be really interesting to get a sense of credit card debt. Yes, buy now, pay later. But for those people who still do use credit cards, how many are making a lot of purchases on them? And we get a lot of earnings today, including aftermarket Lululemon, Restoration Hardware, Vail Resorts, and Broadcom. I'm just saying, some of these I have closer affinities to than others.
Lulu.
Vail.
Okay. Oh, nice.
It's both
nice.
of them. I'm just going to say,
right.
But let's move on.
Lulu, quite a decent year by the looks of it. Lisa, thank you. Ben Lader joins us now, global market strategist at eToro. Ben, it looks like, sounds like, everyone got the Ben Lader script over the last couple of months. We've started to hear this in the last week. The Fed put is back. The Fed put is back. You told us that a month ago. Lisa and I started laughing. Really? The Fed put is back. Does it make you nervous now that that's been normalized, that everyone's on the same page as you?
Yeah, a little bit, if I'm being honest. I mean, Santa's all arrived a little bit early. I mean, Santa's here with his sleigh and his elves and his presents in November. You know, busting the doors down. It's all been a bit dramatic. It's absolutely sort of pulled returns, you know, forward a little bit. But, you know, put that aside, I mean, that's the sort of detail on the timing. I do think the direction is absolutely right. And we've all been given a little bit of a prelude to, I think, what's coming in 2024, which is interest rate cuts and this big rotation from everything that worked in 2023 to everything that didn't work in 2023, and that's going to get a big revisit in 2024, which is Europe, which is the interest rate sensitives, which is real estate, which are all these sort of small, cheaper, out of favor assets, which, you know, you sprinkle a little bit of money on or become a little bit less bearish on, and they fly. And I think that's the story for next year.
Ben, we're like 5 years on, almost to the anniversary of one of the great market calls ever, which was Ben Laidler at HSB saying, get courage up, go long in the market. You've withstood the bears for years, for quarters, for months. What I find fascinating, Ben Laidler, is the narratives that are out there right now, the cacophony of opinion, and just the idea that we redo 2023. Forget about a year-end date. We just keep going with a good news bull market.
So I think that's right, but I think different stocks are going to perform. I mean, I think the outlook for next year is a good one. You know, we've got rate cuts coming and we have, you know, accelerating earnings growth. But I think a different set of stocks are going to do well. The leadership, I think, will be very different to this year. This year was all about the US and big tech and sort of, you know, hugging those defensive growth teddy bears. Next year, I think we're going to be reaching out a little bit more on the risk spectrum. It's going to be the rate sensitives. It's going to be a very different group of stocks. It's going to be Europe. It's going to be overseas. It's going to be real estate. It's going to be small caps. It's so I think the headline numbers may look, you know, as green, but I think where you get it from will be very different.
Are you going to sell the teddy bears to go into those other non-performing areas, or do you hold on tight, Lisa, to the Vermont teddy bears as you go into small caps? What do you do, Ben?
I think you probably hold on to most of that for now, but I think the story for next year is, as we get comfort that we're moving through the US slowdown, as we get closer to the catalyst of those rate cuts, you sort of ease off on the teddy bears and get a little bit of the courage and buy some of those other assets. My point would be, though, I still think the US and tech's going to do fine, right? You're still seeing, good earnings growth, et cetera, et cetera. And a little bit of money goes a very long way in these other asset classes. Tech is 10 times the size of real estate. The US is 5 times the size of Europe. We don't need much of a reallocation for some of these assets to really fly.
Do oil prices worry you, Ben, given the fact that they've fallen to the lowest in more than 5 months?
I think it's a big tell. Lower oil prices, weakness still out of China, PMIs, especially manufacturing PMIs, in recession for, months and months. All this, I think, is just telling you that, under that sort of Teflon-coated, consumer-coated surface, things aren't great. And that's pulling forward these rate cuts, and that's great for stocks. This is a very long-duration stock market. It's much more sensitive to inflation and interest rates than it is to the real economy. That's why we have, double-digit earnings growth penciled in for next year, despite a pretty big deceleration in the U.S. economy.
Although, with all due respect, we're seeing German stocks rise to the highest levels ever, led by even auto manufacturers. Mercedes valuations just surpassed LVMH and Richemont. I mean, talking about a luxury type of producer, even as output in Europe is falling, including in Germany, and we're likely in a recession. How do you get optimistic about buying shares at these valuations in the face of a declining output and the potential for bad news to be bad news, particularly for certain regions that are heading into recession or already in recession?
Yeah, absolutely. Markets are forward-looking. Germany's been in recession for at least 6 months here. European, German valuations are 30–40% lower than they are in the US. First into the slowdown, first out of the recovery. I think that's the story here. And the ECB will probably get the courage of its convictions and end up being the first major central bank to cut interest rates.
Ben Laidler, on the commercial banks, are they attractive here?
I think so. I mean, there's a big difference in banks globally. Banks have been some of the best performing stocks in Europe this year and some of the worst in the US. So it depends a little bit where you look in the world. I think the lesson from the US banks this year has been, the lazy narrative was high interest rates is good for banks. Actually, the opposite happens. So I think when rates get cut, when growth firms up a little bit, I think banks will do very well in the US.
Hey, Ben, great call over the last few months. Ben Laidler of eToro, the market moving towards the equity market bull that is Ben Laidler. Let's turn to crude. $70 right now, briefly into the 60s. I'll catch up with Liz Young of SoFi a little bit later this morning, around 9:30 Eastern time. Her line this morning, this is a market of massive contradictions. Bramo, look at crude. Didn't stockpiles fall yesterday?
They did.
Okay, so how on earth has this got anything to do with weaker growth in America?
Which is the reason why people are looking to supply, and they're saying this is U.S. production hitting record highs and forcing the hands of the OPEC Plus members to basically cut further in order to continue to maintain the price, that basically they're offsetting and then some of the cuts that we're seeing, and then other people saying that some of the cuts to production in the OPEC Plus nations were voluntary. So they're not going to actually do it. And that's the other speculation.
I won't pretend to know that I know what's going on.
Yes.
I'll ask Paul Sankey that later this hour. TK, just to highlight those, some massive contradictions in the past day or so.
There is, like 1986, and that's the great fear of the Saudis and the rest of traditional OPEC. They've lived this before. I would suggest the Russians are removed from that. And, the plus part is removed from that. There's an inbred sobriety to OPEC about when the microeconomics, the equilibrium of oil slips away, and all of a sudden you're at $50 a barrel.
I'm not sure where the sobriety is right now. I don't know that I understand anything about oil prices, and frankly, the fact that people are saying there are weird trading things going on means that nobody really understands exactly where this is headed, or whether this is a bearish signal or a bullish signal or a return to the future or whatever this is with respect to some of the dynamics.
A price sets narrative, Tom.
Yes.
And the narrative at the moment is based on a price at the moment, and Lisa talked about this yesterday. We're just extrapolating out current market conditions
Yes.
and what they seem to be telling us or not 6 months out.
I totally agree, and I thought your tweet yesterday, John, was brilliant about, well, somebody's got a narrative about global slowdown, and somebody's got a narrative about the beneficial aspects of lower interest rates, and the answer is that's sloppy microeconomics within macro, where there's other moving parts here besides that. The moving part going Thursday, today, and Friday, Slock said this at Apollo Global Management. Today matters for tomorrow. It's about jobs.
Jobless claims into payrolls on Friday. It was only 2 months ago. 2 months ago, we were talking about the potential of triple-digit crude, and we had yields at multi-decade highs. And Lisa, the framing mattered then too. We were asking the question, okay, is that the reflection of an extension of the cycle or the ingredients to end it? And now it's like totally the opposite. We're in the 60s on crude and we've got yields coming lower again. Okay, are we reflecting the end of the cycle or the ingredients to extend it? Which one is it?
This is why it's increasingly getting confusing, and the narratives I'm ignoring more and more and just looking at actual earnings of specific companies, of consumer credit, of consumer sentiment, other things, because this is not making sense.
No. Do you know Vermont Teddy Bear?
What's that?
Vermont Teddy Bear was a boom stock here ages ago. They went private in 2005, taken out of the 35. Look at that. Lisa, under John's artificial tree, flannel bear, Vermont Teddy Bear, on sale today.
You need to give them the news, Tom. This is how this works.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, Friday on Bloomberg Television and Radio.
Nikki Haley, she caves anytime the left comes after her, anytime the media comes after her.
Now you have Reid Hoffman, the person who's effectively George Soros Jr., funding lawsuits across this country against Donald Trump. We discovered this week that he is one of Nikki Haley's largest supporters.
I'll tell you this, I've known her for 12 years. This is a smart, accomplished woman. You should stop insulting her.
I love all the attention, fellas. Thank you for that.
That's a brilliant comeback. Nikki Haley in the firing line of the Republican presidential debate. Donald Trump skipping out once again. The former president still the favorite in the GOP race. But Terry Haynes of Pangea Policy warning this. This is a real race. 6/10 of the GOP early primary voters don't want Trump. There's a wrist stiff electorate, and it's likelier than not that it shows in these primaries. It won't take much, a little Trump underperformance, and the race will feel very different, Tom.
Huge statement, and it goes to the heart of the panic right now that I see in more neutral press and even more Democratic Party press. Joining us right now, Terry Haynes with Pangea, a really timely discussion here, staggering to January. Terry Haynes, the zeitgeist out there is OMG, a red nation, a Republican presidency, a Republican Senate, and now a Republican House, maybe, maybe not. Where are we heading here? Are we heading to a Republican sweep?
I think where we're heading is very much like what you see today, Tom, frankly. Whether or not the president is Democratic or Republican, I'd still give Biden in a Biden-Trump race, I'd still give Biden a little bit of edge. So let's start there. I think what you've got is a Senate that is more likely to be marginally Republican majority and a House that's more likely to be marginally Democratic majority. So it's another version of the same thing. People will spend the next year winding themselves up about this, but the reality in Washington is unless you have a sweep of all three parties plus a 60-vote majority in the Senate, which nobody's had for decades, not much changes.
Do you see a Trump-Haley ticket? I was asked at least 3 times this week about that. Is she running for vice president?
No, I think she's running for president, and and I think she's doing reasonably well, as I say, and as you all kindly headlined. 6 out of 10 Republican voters don't want her. Even in the Trump numbers in early primary states, 1/3 of those people at least are what pollsters call soft. In other words, willing to entertain other options. Iowa has a history of surprising. She's very much running for president and thinks that if a couple of breaks go her way, she might well get the nomination. And if that's the case, polls show today she'd do much better than Biden would do. So there's a path there for her, and she sees it and she's trying to seize it.
Could you develop a little bit more what that path is, considering the fact that Trump is still polling at about 60% of Republican voters, and she currently is at 15%?
Well, the path is this. Firstly, throw out the national number. At no point in the presidential race is a national beauty contest number ever relevant. It's all about getting the nomination. It's all about primary states. You get down to the primary states, Iowa and New Hampshire. Now Trump's at about 40 to 45, depending on the polls. So what you have is you've got 55 to 60% that already don't want Trump. 1/3 of those, as I say, are at least willing to entertain an alternative. So it doesn't take much to see the quick consolidation in the race that's already happened, combined with some Trump underperformance. Say, a lot of those people decide, gee, what I heard from Christie's right. Trump's not really going to be able to govern or anything else, and make a break. All of a sudden, what you've got in the first race or two is you've got a real race where Trump looks like he's underperforming, and the not Trump field is coalescing. That's the race Haley sees. My only point is there's a much bigger chance of that than most people are willing to entertain, because I think, frankly, they're blinded by the national number.
In the meantime, Terry, there's this question around the ability to govern before that, especially heading into the new year, given the fact that Kevin McCarthy is going to be stepping down, the former House Speaker, who is going to leave at the end of this year. How much more likely, given the thin majorities, how much more likely does that make some sort of government shutdown?
Well, I think marginally. I think there's a likelihood that what you see either in January or February from House Republicans is some sort of a shutdown. A lot of this, the vast majority of this, of course, is performative. They're wrangling over 30% or 1% cuts in 30% of the budget. So it's not as if they're taking an axe to anything. But what they'd like is some backtracking in spending, and you heard that from the presidential candidates last night, where Haley frankly proposed something return to pre-COVID levels than even House Republicans are doing. So they want a nod in that direction. But there's not a lot of meeting on the spending thing.
Terry, the middle of July next year, the Yankees are going to be playing 700 baseball with Aaron Judge and Juan Soto. I mean, it's a no-brainer right there. There's going to be a confab in Milwaukee. to the convention in Milwaukee and, frankly, the Democratic equivalent. Are these going to be normal conventions?
If Biden is the nominee, it's going to be a fairly normal convention. If Trump is the nominee in the Republican Party, I'd predict kind of mass defections and even a temporary split in the party as a lot of people walk out and refuse to support. Not unlike, in a very broad sense, not unlike what happened to Democrats in 1972, where a lot of the traditional Democratic coalition, including Labor, refused to support McGovern and instead supported Nixon. I think you see a lot of that stuff. The other great unknown between now and July is what happens with third-party races, whether it be with Bob Kennedy, whether it possibly be with Joe Manchin, somebody else. As I say, I think there's a huge restiveness in the electorate, and you could see a third-party candidacy gaining fire really quickly.
When do we see the machinery to have a third-party candidate? Is that a January event, an April event, or dare I say into the convention season?
I think more like a March to April event, frankly. That is kind of what the No Labels people have promised. But more importantly, what No Labels has promised is the idea that, look, once things begin to take shape and we know whether there's a Trump versus Biden likelihood or not, then we'll make a decision. So you're looking at Super Tuesday in early March, and after that, I think you probably get a decision.
Terry Haynes of Pangea Policy. Terry, thank you. Just got a new outlook for you from BNP Paribas. Let's get into it. Still searching for a landing. The outlook for 2024, 4,300 on the S&P 500, by the way. That's the price target. Here's a standout quote, Bramo. GDP growth is set to decelerate considerably in the US and remain stagnant in the Eurozone. The Chinese economy has passed its trough, but will lack momentum going into 2024. Not exactly constructive from the team at BNP.
Greg Baudel over there has been one of the bears consistently, and now it's sort of a question of, is this just, we were right, it just came a year late? And is that sort of what we're going to increasingly hear? And again, as we talked about with JP Morgan, the rationale a lot of people can get behind. Question is, we haven't really connected the narrative with any consistency to the price action.
I think we got on TV, we've got the Great Wall with 4, 5, 6 estimates of where the Standard & Poor's 500 is going. I think we need the blinky wall with like 35 narratives up there and what the different shades of color. I don't have a clue what, I think it's just...
I see a lot of this though, Tom, jumps off the page for me in this outlook. The distinction between the call on the front end and the long end. We believe in higher for longer when it comes to long end yields, but not the short end. We expect curves, Lisa, to bull steep, and I've seen a lot of that kind of thing.
Given the fact that people are expecting rate cuts, but they don't expect some of these narratives to go away. Think about the just sheer amount of debt that the U.S. is selling. Remember when we used to care about the Bank of Japan abandoning yield curve control? Suddenly no one in the U.S. bond market cares. I mean, honestly, this is one of my big questions. I came in today and I was like, this is going to be a big move. And it's what, a couple basis points?
Right. They care about Thursday today and Friday tomorrow. It's about the American labor market. That to me is the key distinction.
This is why I think it's a much better time to do it. The fact that you can start to think about hiking interest rates when everyone else is talking about cuts.
Exactly.
Much better time. You do this in October, middle of October, you drop this kind of language. Oh, can you imagine that morning?
That would have been really...
Very, very different. Equity futures on the S&P just about unchanged from New York City this morning. Good morning.